tonight is I'm going to do four seminars really particularly around currency risk management. Okay, and I've adjusted the course a bit from the past, where I'm spending more time on the the more challenging work. Okay. Be interesting if you remember last week we talked about black swan events. I gave the example of black swan. I noticed in the Age newspaper today there's a heading in the business section saying, how can financial markets detect black swan events? Well, they are like an earthquake hitting a nuclear reactor in Japan. How probably the Japanese would know that they're going to get hit by earthquakes, but the consequential risk of the nuclear reactor, perhaps they didn't think about that so carefully. Okay, but certainly you know of examples if you read about Tokyo where the buildings did sway, 20 metres. And people were scared because it happened, but it was meant to happen. They sway, but they don't fall down. So obviously there's a few lessons to learn, and you'll see also the international community now sort of saying that nuclear energy is not the way to go. Okay, but not everyone's in an earthquake zone. Okay, so big discussion there. So anyway, it's an example of a black swan event. Okay. All right. So I'll do some introductory here, and people here from different backgrounds, and some of you might be very familiar with some of the stuff I do in the first hour, and others not so. Okay, there's students who are doing this without any background in finances as well. So I'll do that, and then I'll go on to some of the forecasting, and some of you know that I do trade markets, and I've been doing some research in particular in forecasting that benefits myself and my students, I hope. And I've found some interesting techniques which I'll share with you that I've come across in the last month, and I'm finding out these things have been around for 90 years, where people just forget about it. So anyway, some interesting stuff to share with you, and I can show you my certainly recent experience. Okay. Also, you'll notice if you go onto DSO, I've loaded up a lot of the study guide chapters, also on the topic guide, and I have loaded up a little bit from the, I told you I got this software package called the Forex Pricer, and I've actually just rewriting a bit of the manual, so I'll have it up this week as well, but I'll break it up into parts regards to different instruments rather than give you one big zip file, okay? And they're really spreadsheet files rather than, if you like, a software package, and it's just one little bug there, but it should be okay. Also, I've uploaded your assignment as well, okay? So, and if we've got some time tonight, I'll just go through it briefly for you as well. Okay. All right. So, well, perhaps before I start, we're talking about foreign exchange markets. A really unusual thing happened, I thought, last week, is that Japan had that major earthquake, and then throughout the next week, the yen currency strengthened. It seems, we're going to think that the Japanese economy is going to struggle, and yet the yen strengthens, which is a real nuisance for them because it makes their exports more expensive. And I think that you have to look at the particular cultural factors, and my understanding is that the Japanese themselves, because when they put money in the bank, interest rates more or less nothing, they therefore invest in international bank deposits. Okay, and with that particular event happening, must have been incredibly large numbers to move the exchange rate, start liquidating those positions and bring their money back to Japan. So I sort of wonder about that, because a whole lot of individuals or even large institutions, unless they've got millions and millions of dollars, they're not going to move the exchange rate. It's too big. Okay, but that's some of the arguments, and I guess if you've got the institutionals doing it, because they can move the market, the yen started to appreciate. Okay.
I read an article recently that the cause of it in part was usually the currency depreciate because foreign investors
Pull their money out, yeah.
But so much of the investment in Japan is by the Japanese people themselves anyway.
Yeah.
But the reason for the appreciation was that so much insurance in Japan is done by international global insurance companies, that those international insurers are pouring money into Japan to make the payments.
Yeah, that they expect in the future, yeah. So, I mean, that's going to be big dollars. Yeah, so I think probably, sounds to me that would probably be the major factor, because that's billions of dollars. And the other one's just a side impact. Yeah, so it seems strange, and also, and look, the Japanese, the Bank of Tokyo, is quite a manipulator of the exchange rate, so I would think that they'll probably start selling it down a bit to try and get the yen down, because yeah. Sorry? Oh yeah. It's whether they do it, but you're right. Yeah, so they might intervene. You know, traders love that. I love that. Start to intervene. They're going to sell. Well, why not just join them? You know? I would, right? I will. Okay. So anyway, what it's out there in the real marketplace. Okay. So obviously the foreign exchange is a result of trade and international money and capital movements, and really when you think of it, trade is goods and services. But in effect, when you think of it, there's probably about $4 trillion a day goes through the international financial markets in currency. That's not explained by buying motor vehicles and sound systems and capital equipment. Okay, the largest percentage of foreign currency transactions are made by international banks and hedge funds who are effectively trading the currencies. Okay, I mean, I haven't seen the latest numbers, but it's probably, look, I'm guessing it's at least 75%. It's mostly trade. So when you see that Goldman Sachs make a really enormous profits, it's because of their trading operations, not just in currency, but of other things as well. Okay, so it's become accepted practice to do that, and the biggest traded currencies are euro, US dollar, and the other one, which is very popular for currency traders, is the Australian dollar, US dollar. As far as our size of our economy, it's small compared with the other major economies in the world. Yet, in currency terms, it ranks about fifth. I mean, it is a big player for speculators. Okay, so the capital movements, yes, and to be honest, if you have probably a $500 million transaction in Australian dollar, it will affect the exchange rate. So you probably wouldn't put a whole amount through for 500 million, 1,000 million, that would have a major impact. Okay. So an example is in BMW sells a car to a car dealer in Melbourne. Australian Bank places the excess funds in the euro dollar market. They have to buy US dollars. And sell Australian dollars. Okay, so assuming that obviously the BMWs come from a plant in the United States, obviously it could be euros. BMW make cars in Europe, in the United States, and in South Africa. Okay, so obviously you have to buy them. So there's a quantitative relationship between the exchange rates. In this course, as I said, I will just use an indirect quote. First currency I'll use will be one. Okay, it's really easy to get them confused, and I know that many of you do MPE 707. Okay, where it follows the textbook fairly closely, and it will quote slightly differently. Okay. But the results will be the same. Okay, so I'm just saying I'll be very clear. I'll only quote it one way, and I'll more or less do what's just the international convention. Okay, like Australian dollar, US dollar. That's how it will be quoted in the US and here. Okay, here I guess you call it. Here it's an indirect quote. In the US it's a direct quote. Okay, but the first currency is one. Okay. You've got to be very consistent in doing that when you have currencies that are on par, like Australian dollar, US dollar, just about par. I'll be consistent when I do with one, which will be the Australian dollar, and that's the first one. Okay, it's about 1 to 99.80 now, and by the time the class finishes, it might be 1 to $1.20 or something like that. Okay, so that could happen. I just checked it before I came. So it's a very strict quantitative relationship. International currency markets in probably the major 5 or 6 currency pairs are very competitive. You know, the spreads are very tight. Euro US dollar spread in the banking markets are two pips. It's a very small spread. I checked a currency this morning, which you might call an outlier, Euro Canadian dollar. Okay, and I checked that this morning at about 8 o'clock when the markets sort of open here in Australia. At about 8 o'clock on Monday morning, I open in first market after the weekend is in New Zealand, and then it opens here in Australia. Very little trading, and this currency had a 12-point spread. Okay, so it's a lot. If you've got a 4-digit spread, it's the last 2 numbers, 12 points. Okay, I checked it before I came to the class here. Okay, and it was 6. The spread was 6. Okay, and that's a result of the liquidity coming into the market. Okay, there's more transactions. So the spread goes down, and I would imagine that probably at about 12 o'clock tonight it might be down to about 4. Okay? So the major players, they won't go in with the 12-point spread. Okay? Right. So that's one, that will never get down to 2 though. Okay? So there's strong quantitative relationship. Okay? The major currency pair obviously is the US dollar euro, okay, which has only came about in 1999, okay, and that's the largest one that's traded. And generally anything that doesn't have the US dollar in the equation is called a cross currency. Okay, they call it the crosses. Okay, and that means that the US dollar is not in it, because time's gone by, you'd have to work out what it was to the US dollar and then convert it to the other currency. So you'll find on the news they use the term crosses. It's generally one that hasn't got the US dollar, like pound Aussie would be a cross rate, just because the US dollar is traded so heavily. Okay, so the market is primarily in those particular centres, but the currency market's very different. Okay. It's very different. Is that it isn't a market like a stock market. Okay? You can't log into the stock market and find the price of the stock. Okay? The currency market feeds through by different brokers. And there are different brokers throughout the world. And at the same time, the brokers can have different prices. So it's because the currency feeds through the banking system. Nowadays we have these ECNs, they call them electronic currency networks, where there are players out there that act as brokers that take feeds of prices from a number of different brokers. And in fact, you'll find that some organisations take prices from different brokers, and you might do a transaction, and they will pick the best price for you. If they're good, the worst price if they don't like you. Okay? So, but they will pick it, so it's quite complex. Not, you know, when you see a screen and you see a price there, it could be a couple of pips, 3 or 4 pips away, points away, and in another market. And I had that experience, and I can explain it, and you can see it fairly. Well, it's not so easy to see unless you get 2 up on the screen, but you know, I have the ability to do that. But primarily, these 3 markets are the major currency markets, and London, because of its being, you know, through the 1700s, 1800s, just to being a big trading centre, you know, because, you know, the English were, you know, their ships were going all around the world, and they're setting up all trade, and this country here is a response to that, and many others, that the pound was used for a lot of currency transactions. So essentially London is the centre, okay, but they don't have to be. You know, you can have brokers here, and there are a couple of brokers here in Melbourne, in fact, okay, at the moment that could, you know, trade on international markets, and you can use them. The good thing about dealing with a broker that is in Australia is that they're regulated by ASIC, and they're unlikely to steal your money, while a broker in Malta I might think of differently, okay? Or, yeah. Okay. So New York obviously is the other big centre, okay, and And Tokyo has always been a big trading centre as well, okay, where the yen is obviously the principal currency. Okay, so most widely trades the US dollar, I'm sure you're familiar with that. And in many countries, the US dollar is used as a supplementary. You know, and those of you who lived in Asia or travelled through Asia in particular, or other countries, Africa for example, will find that the US dollar is easily you can easily do transactions in the US dollar. Okay, as if you read my bio a bit, I've been lucky enough to work overseas a lot and to travel overseas. More recently, a bit unusual places, but I travelled in Russia in the 90s when it just converted to a market economy, and I can vividly remember going into a grocery store, and outside the grocery store they had a little currency exchange, and I converted my money into rubles, okay. And I went into the store and bought some probably toothpaste or something like this, right? And then I came out of the store and they gave me change. And then you go back to this little shop and you give them back the rubles and that you got left over, and they give you the US dollars. Now, I was doing that. I wasn't a permanent resident of that country, right? I was working there, but the locals were doing that because the ruble was devaluing at 20% a month. So their major function of currency is a store of value, so it's no store of value. So people don't hold it in rubles. So we used to call it the ruble, okay? But that currency is stabilised, and I actually went there, part of a Deakin group, to help the mining industry prepare accounting reports. And I mean, you couldn't do it because at that stage, for the first time I went, it was 30% a month was the change in the exchange rate. So, think of a value of an asset on a balance sheet. It's dropped in 30% in value 1 month. It's hopeless. You just can't possibly do the analysis. It's a waste of time. So we have to change what we're doing. I mean, it was really trying to help them cope with their shift to market economy, and in those economics becomes important, marketing becomes important rather than financial statements because they're meaningless. Okay, so many of them, and the example of Russia that I have, Argentina actually doesn't have. Argentina for a while has had a very checkered career regards its foreign currency. Big devaluations, all of a sudden, and Argentina fixed its exchange rate to the US dollar, so they just got sick of managing it themselves, so they just fixed everything to the US dollar. But what happened is that they still had loans. The US dollar strengthened, and when they come to try and pay these loans, they just haven't got nearly enough money in their own currency to repay it. So they broke their nexus with the US dollar. I think there's one country in South America that still has a peg to US. I think it's Ecuador. Ecuador, Allende? Yeah, Ecuador does. So,
well, they went through dollarisation.
Yeah. So I don't, even though Ecuador, perhaps they've done it for a couple of years now, I would think. 5 years. So
that is funny because the president doesn't like Americans at all, but they use their money. They sell the police and all the bank decisions in the United States because he can't do nothing.
Yeah, it just shows. I guess the interest rates are fixed to US interest rates. Yeah, well, I mean, I guess the economy must be okay if they can do that, but.
It's good to store the value because it's more convenient like that.
Yeah.
What do you think they use?
Yeah, I mean, that becomes their store of value and it's easy to do, but Argentina's experience wasn't very good. But Argentina's had an economy that's very variable over time.
Venezuela now has a big problem because the government fixed the exchange rate.
Yeah.
In the black market,
Yeah.
you could find
4 times.
where the value is incredible. And if you are a Venezuelan resident, you are just allowed to take with you $2,500 in 1 year.
Yeah, outside the country.
And you can use any other credit card. It's very, very restricted.
Yeah. Okay, well, countries that have done that, South Africa. South Africa did that in the 1980s. Okay, they fixed the exchange rate. In fact, they had 2 exchange rates. One for just private dealing, another one's for companies, another one for government. Anyway, what some of the South Africans did is they built themselves a very big boat worth $1 million, and sailed the boat out of the country, right? and sold it in Europe for $1 million. That's how they got their money out. Okay, so I'll talk to some other recent examples I've had as well. So stability of the currency is very important, and people in this country are somewhat critical of the variability in the Australian dollar. And you'll see from the notes there that in recent years it's been as low as 47 cents and as high as $1.02, I guess, is about the highest, which is recent. And that's a big move. But the thing is that what it does in this country, the floating exchange rate really means that the economy adjusts, okay? And it means that you don't have as much sort of fiscal stimulus required because the economy will adjust, the exchange rate adjusts. Well, it's fixed, like you say. In these less developed countries, when they fix it, it just opens up this black market, okay? And then you have to have all the regulations to control it, okay? So I've seen that happen. Travelled in countries where it's been a fixed exchange rate, and you know I have changed money on the black market, and I will do that in those countries as long as I know it's relatively safe, okay? If there are countries where it's not very safe, then obviously I won't do that, right? But many countries just turn a blind eye to it, you know, because places still got to work. Okay, so they're the major currencies there, and you know, like this Japanese economy, you know, probably hasn't really done much for 20 years. And it's got its own structural problems, you know, besides what's happened with regards to this earthquake and so on. You know, I have a friend over there, I think I told you about, a young guy, about 26, works in Osaka as a lawyer. You know, he works a 12-hour day every day. Okay, there's no problems. They work very hard. You know. But they have some problems with the people. They've got an older structure of the population and things like this, so they've got some difficulties. Okay, so Euro, I've got some notes in later about the Euro, and David here actually comes from here. Have you got any European students here? Anyone else? Perhaps during the day there's a couple of Scandinavians. No? Okay. Yes. Pardon? You can't hear. Okay. Okay, this should help. Is that better? That's why I asked before. Okay. All right. So the other one is, the euro was developed in 1999. It's very interesting that the euro was developed, really, in my view, to compete against the US dollar, to make a trade bloc. And when you think about it, if you're travelling in Europe and you could go a couple of hours, in fact, within 2 hours you can move through 3 countries. And I've been caught. I've been stuck on a motorway. And I'm only in this country for 15 minutes, and I've got to pay the motorway. I haven't got any of their money, you know. I mean, but you know, anyway. So now it's not less likely to happen. But the euro is interesting in its development. But what it does is, the problem is that if Greece has a problem, if Ireland has a problem, everyone has a problem. Okay, and that's what they found out, because the countries give up interest rate management to the European Central Bank. Now, interest rate management is done, I think, relatively effectively in this country. Okay, I mean, everyone can criticise the Reserve Bank, but I think because data is available so quickly, they are fairly proactive regards to interest rates. Okay, because I can remember the time here where they were 17%. Okay, so, but that's a weakness there. I guess it's got to be balanced up other things, and that's a big political thing to do that. You know, it's a president of France and I think a chancellor of Germany were the principal guys that did it, okay, and I brought the other currencies with them. Okay, the pound is not, the UK is in the Eurozone, so it's got benefits, and if you've got a UK passport that's equivalent to a Euro passport, okay, Euro passport, very valuable, Euro passport, okay. I have a friend who's Dutch, and he has not. He would perhaps consider taking out Australian citizenship now because his 2 children have got Dutch passports. Right, that gives them Euro passports for life. Okay, so that's what people do because that's so valuable to travel through those countries without going through passport control all the time. Okay, so the pound doesn't give up their currency. Okay, they still have the pound, and in my view, there's no way they ever would. Okay, this is a Swiss franc, just called the chef. Okay, it's very strong currency, the Swiss currency. Okay, it's a very strong. Pardon?
Very traded.
Yeah, and it's a smaller economy than Australia. It's 6 million people, and it's very heavily traded. And they had an incredibly strong banking system until recently, right? But they'll probably recover, right? Because a few of their banks got caught up. Okay, this is Canadian, okay, and the Australian dollar. Now the difference in this behavioural patterns of these currencies, because I've done a lot of work in this area, is the Canadian, the Australian, and they'd add the New Zealand dollar, are very much what they call commodity currencies. That is, they react to the major products of those countries. Now, the major products that we sell overseas in Australia are coal, iron ore. They're all mining things, okay? And payments are mostly received in US dollars, okay? So if you think, you know, look, the biggest impact, I think, on the Australian dollar has just been the economic development in China. And many of you will be familiar with that because you come from that country, right? So the economic development of China increases demand for iron ore and coal and so on, and therefore there's a bigger demand for Australian dollars and it'll go up. If China keeps going up, you know, I mean, they're worried about the Chinese growth going below 10%, and I don't seem to be too worried about that. Oh, it's 9, crikey. So I would think that we can, and that's what I think the reason is, okay? It's just not suddenly that they like it. The Canadian dollar, not everyone realise, but Canada's a big oil producer. Okay, Alberta you might have heard of. You know, they dig it out right up in the north in the Arctic. You know, they've got challenges getting oil out up there, and they've got these incredible other deposits as well. You know, in I don't know what they call it, but sand oil. It just costs a lot of money to get it out, but at $150 a barrel, they might be worth doing it, yeah. So they're commodity ones. So you've got to think of what's the impact on the oil price, and you'll find at the moment is the Canadian strengthening against the US dollar because of what's happening in Libya and the shortage of oil, perhaps. Okay. Here, this commodity one, and I'll show you later. There's an index that has a close link to that. Okay. So obviously, I mentioned that. Okay. Okay. So time zones. If you go to this site here, okay. Forex Signal Live, you can get a little tool and you can put it on your computer and it'll tell you the time zones of the different markets opening, okay? Because what happens is when the foreign currency market opens here in Australia about 8 o'clock this morning, it'll trade through an Australian time, it'll trade right through until 7 o'clock next Saturday morning, okay? That will be about 4 p.m. in New York, okay, 17-hour time zone, okay, difference, okay, so it'll start trading, but it has different times. So what happens is the Japanese market opens about 11 o'clock here in Australia, and then the UK market opens at about 6 o'clock, okay, and then at about 12 or 1 o'clock in the morning the US market opens. So it sort of trades through the day, and then when the UK market, the volume jumps again and stays quite high, and then when the US market comes in, it goes up again and drops away because the UK markets change. And that's because traders in those countries trading the currencies. And you find towards the end of the day, it then sort of drops down in the US, okay? Some people trade a pattern where the currency, US dollar, just always sort of comes back later in the day, okay? And then the pattern goes right throughout the week, okay? So those volumes are fairly predictable, and that gives you a sight. Okay, it's a bit tricky because at the moment, okay, here within Australia, okay, in the United States they just stopped. They just introduced daylight saving in the US, and we have daylight saving here at the moment. Okay, but must be within 2 weeks or something. We must go off daylight saving, so we're going to get an hour shift. Okay, so you know I've been stuck in, and there was one time when actually it was in October when both the United States and the Australian daylight saving was changed on the weekend, so the market's changed by 2 hours. And my wife was overseas. I couldn't work while she wouldn't answer the phone, but I had a 2-hour shift in the time because you know she told me that they changed it. I said no, it's not true, you know. But I went on the internet and found it. So you've got to be tricky with the time zones. changes and that. Okay, so there's heaps of resources too. Okay, so these examples, and I alluded to it just before about the different types of exchange rates, and you give me, I haven't got it here, right? A dollarisation really is what you talked about. Is that they fix it to the US dollar and use the US dollar as a principal currency. Okay, and some currencies are tradable outside other currencies, right? But I think I might have told you the first day I've got some Bolivian currency. It's called Bolivianos, and I got caught with them when I left Bolivia in 2009. I still have them because no one will change them, right? Okay, and I have another currency called a Myanmar currency. Chats they're called, and I always keep a few, and I've got those, but I can't change them either. Okay, but there are other currencies where you can easily change outside, but some of them are restricted. Okay, so you might have a fixed exchange rate, and as Eliana was talking about, is that Venezuela got a fix to the US dollar. Okay, so it's fixed. Okay, the one is relatively, if I use students from China, I'd say it's fixed the US dollar. You frequently come back to me and say it's changed. Well, it changes at about the 6th decimal point. Okay, all right. So obviously the one is gradually appreciating against the US dollar, but very small amounts. Okay, and there's pressure on it to increase it. Okay. You know, a major fixed exchange rate is the UK dollar, the Hong Kong dollar to the US dollar. That's been fixed for some time. Okay, so you know that's 8.12 or something, and 8.12. Okay, it might change in the 6th decimal point, but that's hardly relevant at all. Okay, so single currency going back to 1960s, 1970s. You know, they're all fixed. Everything was fixed. Okay, okay. So other countries might use a basket of currencies. You might, and these have all been tried at different times. You might weight your currency to the movements in your trading partners. You know, so for instance, our trading partners are 50% yen, 40% US dollars, 10% other. So we might sort of weight them according to the changes in the yen and the US dollar. Okay, because they're our trading partners. Okay, we might provide some flexibility. For instance, you could argue that the Chinese yuan and the US dollar has some limited flexibility. Within a range, there might be movements in the exchange rate. Okay, but it's managed. Here in Australia, I've mentioned it as a managed float. There might be agreements, okay, among particular currencies to perhaps fix the exchange rate for a period of time or for particular activities. Okay, you'll find this. Examples of this would be in African economies. May adjust to an indicator. So everything you can think of, you could use that. Okay. The managed float here happened in Australia. An example of this would have happened 1970s, 1980s. They used to fix the exchange rate each day. The 3 people would meet. Someone from the Reserve Bank, someone from Treasury, and must have been a treasurer, someone like that, or his representative. 3 people would meet each day, and they'd fix the exchange rate for that day. Okay, so it was sort of managed. Okay, and what they might say that over this period of time, here's the maximum and there's the minimum. Okay, and exchange rate moves like within that. Singapore dollar does that a bit. Okay, you think that the government's manipulating it, just goes up and down. Yes, it is. Right? Okay, so but I mean that's to their advantage. The independent float, my view is what we might call a clean float. My view is that the Australian dollar is probably the cleanest float there is. The government here will intervene. The Reserve Bank, it's not the government's responsibility. The Reserve Bank will intervene here in Australia if the Australian dollar plummets quickly. If it drops suddenly, they will do it. If it goes down to 50, if it goes to 90 cents in the next 2 days, they will probably intervene. To build it up a bit. Okay, to just reduce the volatility of the exchange rate. Okay, and I mean that's a great thing for traders to know that they'll do that because they just jump in and ride the coattails of the Reserve Bank. Okay, if you look at Reserve Bank annual reports over the last 2 years, you'll find one thing item is they don't make very much money from currency appreciation. While in past years they made a lot of money when they're supporting the dollar, and it'll go up and they'll sell and then it'll float down and they'll buy again. And they made a lot of money that went into government coffers, okay, but not so recently. But, if it goes up too quickly, they'll intervene just to hold it. But day-to-day basis, my view is they're not in there manipulating it, okay? So many others do. Like we've even had the example here of the yen. They just say they're going to do it. The G7 sort of says it, really. But they have to be very careful, because once they really start to tell the market exactly what they're going to do, then this is exploited by the currency traders, okay? And the currency trader will love to know what government's going to do, and governments have to play the game a bit, okay? Okay, fixed conversion to a floating currency. That happened with the Australian dollar, was fixed for sometimes the US dollar, and as the US dollar went up and down, it sort of went the same way. That's an example. Or you can have a currency board, that's like the people who meet. Indonesia sort of, it was considered a currency board, okay? So you'll find that a number of the Asian currencies are managed somewhat, and I mean some of these currencies do that because of good reason, but because of they're not traded so heavily, buyers and sellers can get here and manipulate their currency considerably, okay? Malaysia's been fairly strong in its own control of its currency, okay? Or you can restrict who buys and sells your currency, as was mentioned before, put limitations on people and so on. Here there's nothing like that. Okay. All right, so I put this here as I travelled in January, late December and January, and I travelled to a country called Burma in the old days, when I went there first a long time ago, as a backpacker, and now it's called Myanmar. Myanmar. And it's a country that sits between India and Thailand, and has China up on the board and Laos on the border, and Bangladesh, okay? So it has a whole lot of countries around it. It sits down there next to Thailand. It's a country that has a military dictatorship, okay? The most repressive in the world is the one in North Korea, and Myanmar would be second in its repression. It's one reason why I didn't want to go, but my wife persuaded me to go. And you just do what your wife says, don't you? Okay? So I'd been there before and I knew what it would be like, but it's still a good experience. Anyway, the exchange rate there is in these, they call that currency a chat, okay? So the official exchange rate is 450 chats to a US dollar, okay? My average exchange rate, and I've mentioned it down there, was 800, okay? So I didn't get nearly double, okay? Now this was done without clandestine, really. It's meet our guide at the airport, at the desk of the hotel, and he'll have a money lender in. Pardon?
You can use your credit
We
card.
could not use the credit.
You'll have to pay the double.
Yeah.
If you pay with
Credit card, you'll get 450. Yeah. Myanmar solves that problem because no credit cards. No credit cards. The only place you could use a credit card was to buy jewellery, like rubies or sapphires, which I bought, right? My wife bought anyway, right? I bought the watch, see the gold watch? See my gold watch? I bought this in Myanmar, right? Okay. Have a guess how much it cost me?
450 yes.
Shats? No, more than that, that's $1. It did cost more than $1, not many more. Right? Okay, cost me $7.50. $7.50. And I've been wearing it now since about January the 2nd. And everyone reckons I was on a tour group. I got to email them and tell them, because it's a big joke. They reckon it'll last 3 days. Because I got some fancy watch that I couldn't change the time on. I don't know, this stupid watch. It's got more dials on it. So I wanted a simple watch, and I never thought, anyway, I've had to have a link taken out. A watch cost me $7.50, just cost me $10 to get a link. Okay? Right? I had a link so it fits me. I was not prepared to go to a watchmaker here in Australia, in Melbourne, and get them to change it, but I convinced one of my daughters to do it for me and paid her, right? I'd be too embarrassed when they looked at the watch, because the top cover looks like it's plastic inside, huh? But it does work. And I mean, gee, I bought when I went backpacking first in the 70s, I bought a real cheap watch in Singapore that was, so much of a rip-off. it'll last me 20 years. So I'll keep wearing this one until it stops, and it doesn't matter. Like I was told that I was ripped off, and you get a better one in Cambodia. Okay, so I did try to get, like there are fakes and there are good fakes. You all know about that stuff. Okay, so I mean that country is other than for jewellery that I noticed, it was cash. Okay, so the problem for us as travellers is that we had to take US dollars. We had to take cash, and with this tour I was on, most of the money was paid for, so you just needed day-to-day stuff. So you didn't really need a lot of money. But because the exchange rate was so variable, we would change money on about 3 or 4 day basis. And my wife she liked doing that stuff, so she'd manage it for the whole people, right? So what happens is also in Myanmar, which I probably mentioned as well, is the most popular currency is 1,000 chat note, okay, which is about $2, okay, and there it's $2. So when you change the money, you say you're doing $100, or even with a whole group of people, it might be $1,000. That's a lot of, it's 40,000 of these things. I mean, and most of the time was given to you in one chat notes. Right? And I got some 5s one time. I just kept them. I didn't share them with anyone. But they were one chat notes. So, obviously it's easy to make payments and things like that. But obviously the currency is not sort of, there's no coins or anything like this. The currency gets damaged, and they're must be to do with their banking system, very particular on damage to a note. If you had a note that had a mark on it, they would not accept it. So they're very wary of counterfeit currencies. Okay, you probably understand. Very wary. So any mark on a note, right? And when we got notes here in Australia, we didn't make it clear to the bank. We said we wanted recent ones, but if someone's written a name on it or a number, they would not take it, or they gave you a lower rate. Okay. So the other thing that is it's 800 chats. Okay, that was an average. It was high as 850, and as low as about 750. Okay. Now I had experience here before because I went here as a backpacker I won't say how long ago, but a long time ago. Right? I was about the age of many of you here, a bit older. And I was travelling around the world with a backpack for about $10 a day. That's what I was living on then. Okay, it's about 70 now, I guess. Okay. So I was in Thailand, and I was told in Thailand when you go into Burma, as it was then, you take whiskey and cigarettes. Right? So I bought a bottle of Johnny Walker whiskey and a big packet of cigarettes. So I don't smoke, right? But I took this big packet of 3-5 cigarettes. Okay. And I said, well, what do? You just walk down the market. People come up to you, right? So we arrived in, this is in 1976 actually, so we arrived in Rangoon, right, as it was then, and we went and showed this YMCA, and then we went to the local market, and I had a bag that had Johnny Walker on it, and I had another bag with cigarettes, and people came up and would negotiate to sell it. It was blatant and very open. We were told from other people who travelled there, don't worry, the police won't worry you, right? You do this, okay. Now, because we did that on the black market, we had so much chats, we had so much money there for 5 days to spend, right? And there's nothing to buy. I got a backpack, you can only buy so many watches, right? So what we did is we stayed at the most expensive hotel, right, in Rangoon, right? Which I did stay at recently, but it was much better than it was in 1976. It was falling down, this hotel. It's called the Strand. It's quite famous. And nothing worked, right? But anyway, so we had to get rid of the chats because we couldn't take them out of the country because they actually check, that you've done the deal on that. So the exchange rate was a bit more stable, but because, we must have got 8 to 10 times the currency, right? It was very high, okay? Nowadays you can buy Johnny Walker there for $3 a bottle, okay? 'Cause it comes in on the black market, Okay, and the other interesting about Myanmar is it's a country where people use everything. This recycling is just phenomenal. So, Johnny Walker whiskey bottles, nice sort of squarish bottle. They're great, right? There are 2 things you can do. They'll make other spirits like rum and put it in a Johnny Walker bottle and change the label. Second one is they sell petrol for motorbikes because they've got a litre bottle. So you see the Johnny Walker bottles lined up where they're selling the motorbike fuel. Some of you got some experience perhaps with that, okay? So recycle everything like that that matters, which is phenomenal, okay? The other thing that's interesting and currency related is the fourth dot point, is that when you moved out of the major city, it's called Yangon, the major city. It used to be called Rangoon, and that's a British name, so locals are quite happy to use Yangon. Once you move out of the major centre, the exchange rate weakened. Okay, so instead of getting 800, you'll start to get 780, 770, 750 as you moved out of the major centre. And why is it? It's because there's what we call a carry cost. It's a cost of carry, right? Is that the further out you are, the less opportunity you have to exchange money. Okay, people give you US dollars, but you know there's not many money changes around in the town that I live in. Right? So people outside the major centre actually didn't want you to give them US dollars. Okay. Also, I was told that Burma or Myanmar is a big centre in the world for heroin. You know, it's probably their best industry is the heroin that they produce. And I was told that once a month the payments are made, so US dollars pour into the country when the heroin is paid for, which they said on a monthly basis, and that means that there's a wash with US dollars, therefore the exchange rate drops. Okay, that's what I was told, but I don't know if that's true. Okay. So if it's interesting, if further you go out, the worse the exchange rate. Cost to carry, you know. It's when you might give $1 to a kid or something, they don't want it. Okay, it's funny. Okay, so the locals don't use the banking system because it's a military dictatorship, and the government can just say, look, you got all that money in the bank. Yesterday we took 20% out of everyone's deposit, and thank you, we've put it into the government, we'll look after that money for you now, right? So that's the risk that people have, because it's happened once. So you don't put money in the bank, okay? The locals hold cash. So banking system's really probably only used by businesses and government. And as our tour guide, who was quite amazing, he was a physicist, okay? He said that no bank robbers in Myanmar. There's no money in the banks. Okay. No ATMs, okay? Every country in South America had ATMs, you know. Bolivia, I was surprised, is a very poor country, had ATMs, and the guy standing next to it had a submachine gun, so he's quite safe, you know, safer than Melbourne going to an ATM, okay? Okay, now US university students I think might appreciate this, is that what happens in a country like that is that the people are very much repressed. You know, there's not soldiers everywhere on the street, but it's done through secret police. And I have a friend in Burma, and I was going to arrange to meet him, and his wife told me not to because the secret police will just follow him around if he meets you, you know, as a Westerner, okay? But what happened here is when they had their latest lot of riots, 2007, the riots and the demonstrations are led by students and the monks. It's a very religious country, okay? Buddhism is their major religion. And the monks and the students are the ones that do the demonstrations, okay? And I mean, they're just being killed and put in jail, whatever. And so what they did with the students now is there's no students in the Rangoon University in the centre of the city. It's like Melbourne University here. You've got a big university, 30,000 students in the middle of the city. No more, okay? All the campuses of the university are spread right throughout the city, in the outskirts. Like we didn't have one here in Burwood, it will be out at Lilydale and up at Hoppett's Crossing and down at Frankston, spread all around. So the students cannot get together. So they split all the students up, and because it's very hard to get internet access, mobile phones, very expensive, so they can't communicate. So they keep all the students apart, okay? Divide and rule, okay, that's how they do it. 90% of people voted for a change of government, and the military government said, oh, that's interesting, got that opinion, but we're not ready for that yet, we'll stay in power for a bit longer, okay? So follow it a little bit and you come away, you know, quite sad about that actually, okay? But
be very aware of what is happening in Libya and Egypt, because it could be the next one.
Well, that's right. I mean, it is. Yes, you're right. I thought of that too, and actually, they'd find out about that through, satellite television and things like this. but it's not nearly as extensive in Myanmar as it is. As I said, I travelled in Russia. I knew Russia could never go back because of the internet, and the Russians are really good at using the internet. There's software engineers in Ukraine. I beat any system there. People are not so familiar with it. There are courses for doing basic Excel. It's just, and that's how they keep the repression. But you're right. I thought about it too. That these young people, there's a lot of young people are unhappy. People leave if they can. Okay, there are communities here in Melbourne, and some of them still wage a war. But you're right. It certainly would be thinking about it. It's very non-aggressive, their demonstrations. But I went and saw a program on like a stage show, and these guys were doing what we call a satire about the government. Okay, and having a go at the government. And three of us went along to this show, and it was a bit tame. It really wasn't what we thought it would be. But when the actors have said that they've all spent 7 years in prison for doing this program in the past, they're not going to take the risk. So it became essentially a cultural show rather than anything political. But 7 years in jail was a standard thing, and they do that. So it's interesting. You really think that hopefully something would happen, like you suggest, because this country is when it's socialist really, and they have the objectives of the country, and it says to be a major agricultural economy. You can't do that nowadays. You won't go anywhere if you just go grow rice. But people are very inventive. Okay, so these are to go from that. Okay, so and I've got heaps of other stories if I want to tell you, right? Other things I've done. I've even changed money on the black market to make money, but lost it because too many people took a cut on the way. I've been in Afghanistan, I've been in Pakistan and Iran, and Turkey. Bought currency in Afghanistan, changed it in Turkey, and I got done. I gave you the bad rate. The money guys changed the money, made all the money from me. Okay, sold jeans in Russia. Okay, all right. So these are the major commercial banks in Australia. Those four. There are other banks as well, but you'll find that the other banks won't sell a range of currencies, but they all will trade. But to set up a whole currency dealing room costs a fair bit of money. Okay, of those four banks there, the ANZ Bank has its head office here in Melbourne, and they have quite an extensive trading room. There'll be 30 or 40 people there. I've had students go and work there, and that's based in Melbourne. And obviously there's an example of the central banks. Okay, the other players that are more popular in recent times are these funds managers. Okay, these are hedge funds. They move big amounts of money at times, so they do get into the markets, a lot more. Okay, the funds managers, hedge funds, importers, exporters. My view, importers and exporters don't make much difference. I've had them say, I've got transaction for $20 million and are worried about it affecting exchange rate. Now it won't. Okay, so you've got these brokers. Okay, now these are things that have changed in the last 10 years. Okay, and continually changing. Okay, is we have all these brokers, and those of you who do MPF, I think 707 in National Banking and Finance, they'll use the Easy4X broker, right? So you might have done it, and one of my students last year was number one, he told me, right? Okay, so you'll pay the Easy4X is a broker based here in Melbourne. There's another one in Melbourne called Go Markets, and one up in Sydney called Vantage FX. They're outside the banks, and actually Vantage FX is owned by the NAB. Easy4X has probably got an Australian financial institution's backing, it should have. Okay, so these are the brokers. Okay. So this one, Alpari, is based in UK. That's a very big one. This one here is a French one, and funnily enough, FX Lite it's called. Its head office is in New York. Okay, so I actually use this broker here, but I don't use it to do transactions. I use their demo account. They have a demo account, which doesn't cost me any money, and they must have forgotten about me because I've had it for 2 years. And I use their demo account because it is matched to New York time. So I know it's in New York time, so I use it for testing things all the time, okay? Latitude FX, that's a New Zealand one, okay? I found it quite good and I was going to use them, and then after 30 days they said no more, so I gave them the flick, okay? And I have an account here but I don't use it yet. Okay, so what I want to explain to you is that what I've found from my own trading and so on, and also from a presentation done last year here at Deakin by a professor from University of New South Wales, or year before, 2009, is the incredible amount of algorithmic trading, okay? Is that in the United States in particular, computers are doing an incredible amount of trading. So software engineers are writing programs, okay, to trade. They're trading on milliseconds. That is, they're moving large amounts of money in a very short period of time. They're actually putting their servers as close as possible to the New York Stock Exchange to reduce the time for the information to flow. I mean, that's phenomenal. That's millisecond stuff. I couldn't believe it. He said, no, that's what they're doing. They have their office somewhere else, but the server's right there. Anyway, that's amazing stuff. So he reckons it was 60%, and I talked to funds managers, and they say no, right? But 3 years ago, when the markets crashed in 2007, I had here at Deakin a funds manager from a firm called BlackRock. They're the largest funds manager in the world, I believe, nowadays. And he was here when the markets were going up and down. We had a meeting here with him about this industry. And I said to him, Andre Brooks his name is, and I said to him, Andre, I guess you're a bit worried about the market. He says, no, I manage the quant fund, okay? So that's a quantitative fund, which is an algorithmic fund. She says, well, it'll just adjust to the market. I don't have to be there. Press F7, it works, okay? So what I've noticed happen here is this incredible growth. And these, the big funds managers and the banks and that have got this algorithmic trading working, okay? And if it's any good, they don't tell you about it, okay? But when you look, they're making enormous profits out of this. So what's happened here is that there's been a development in currency markets of these, you might call them robots, or they're called expert advisors, okay? So if you search on expert advisor robot, okay, and once you sign up, they'll send you emails every day. I mean, I get 6 emails every day from people trying to sell me robots because I had bought them. I made a mistake. I did buy them. Okay. But what I've done is what's very good is the robots might cost you under $200 usually, some as low as $40. If it's $40, it's junk. Okay. But what happens is, what I do is I only buy it if it comes through ClickBank. Okay. So if it comes through ClickBank, they give it to you for 30 days, and then you. If it's no good, then you just get your refund, right? And the provider's got no choice because ClickBank will give you the money back. I've got an argument with one at the moment, right? But I'll get the money back from them, okay? So I trial them for a bit, and I found 2. I found one that works, okay? And I have another one which I know, I'm pretty sure it's an Australian one, which has got performance over a year, which or a couple of years, which is quite good. So a robot. So they make between 5 and 10% a month. Okay. Right, and sometimes they'll make 30% a month. Right. If they make 30% a month, they'll lose 50% in a month too. Okay. Very high volatility. Okay. But there is one that I'm just waiting. I closed my version. I'm waiting for the next version because of the software developer he's an Italian, and he's adapted his robot to what a whole lot of traders have told him. He put up a blog and everyone said, do this, why don't you try this? And he's just it's a fantastic use of a blog because these people are quite experienced and they gave him all these ideas. So he has one and it's been tested at the moment and the results are quite good because it'll make 5 to 10% a month. It's very consistent, very consistent, and he's got a really unique algorithm which you can determine there. It's one thing that will not change, and it works on the principle that currencies. See, the Australian dollar won't go to $2 to US dollar. Currencies revert. The Australian dollar won't go to 0 like stocks. Stocks can go to 0. Stocks can go to 100. Currencies don't go. Currencies revert to a mean, and that's a principle because at times he'll leave. It might be there for 3 months, a transaction. Eventually, he makes a view the currency comes back. So anyway, that's quite interesting. Okay, and I've tested a couple, but I've found two, I think, that work. Okay.
How does it work? You have to log into this robot and it will trade on your account automatically, or it tells you what to buy and sell and when?
Yeah. Okay. What the robot does is that you download the software, and it takes you about 5 minutes to activate it. And what you do is you use a platform, in a currency platform. It's a common one. It's called MetaTrader 4. Okay. And it's got a space on it for expert advisors, and you attach it to the chart, and if it's a robot, it'll automatically trade for you. So it takes signals.
So you put a total amount that you're happy to...
Yeah, you don't put very much money in
Does
it.
that work for Easy Forex, to the 787 or something?
Yeah. Yeah.
It's a good strategy.
Okay, get one of the high performers, you might catch the right...
Talk to you after class.
Then you can put it to bed for a month, can't you? Let it trade, yeah. It's interesting. But I mean, it is, and and there are brokers who have their own expert advisors. Okay, and if you use their site, you can use their expert advisor. Sometimes you pay, sometimes you might not. You can choose, but if they give you choices of 20, it's likely that it don't work. But the other one, this market amazes me. There's another website. It's called Zulu, Z-U-L-U. So this shows the invention of people. So you go to Zulu, and there's guys that set up this broking site, and what they have is they have all these robots or advisors, right? So let's say I developed a software package. I could go to Zulu and say, all right, Zulu, I'm happy to put it up on your website, whatever, and people who want to trade can choose to use my expert advisor. And what you get is you don't sell it. What you get a percentage of the spread. Okay, so you make, as the advisor, you just make a little bit of money all the time. Okay, and there's Zulu, so you could go on and you could pick 6 advisors, and then they run a great big sheet that shows the performance of the advisors. So you can pick the guy getting $100 a month, 100% a month, knowing that he can lose that in a month as well, and you've got no money, right? I mean, volatility, it's enormous. But there are some there that might earn 3% a month and done it for 3 years. I mean, things change, but you never put a lot of money in my experience, okay? Or you have a small amount and you just leave it there and let it compound, But I haven't gone that far, actually, and I found one last year that worked, okay? But so there's all sorts of things, but there's lots of scams out there, so you have to be very careful, okay? But you could. Look, I'm not a high tech person, but some of them are a bit tricky to set up, but you can get it working within 5 minutes, okay? There's the software, so you'd always check it on a demo account, okay? Because you can get a problem in the software and it does a sell, it should done a buy, and you lose all your money, I mean, that's never going to happen, okay? So you have to use it on demo, and you can test it and things like this. And some of them you can actually has parameters, and you can decide within these parameters what risk you want to take. Like a common trader generally would not risk any more than 5% on any one transaction, and many do between 1 and 2. So you can limit it. So even when it stuffs up a bit, it's not going to be too bad. Okay, but some of them. Look, I told you, like there's one which I know of, and I've seen their performance, and because of what information I gathered from this group, I mentioned last week about Monte Carlos. This firm has their robot, and they go and they get all the data over the last 3-4 years, and they run a Monte Carlo through it. That's a good simulation. To me, these guys are mathematicians, and software engineers. So, I felt that was pretty good data they collected, but you can get scams and that, and you'll see that. But the entry, so you have to be careful here, okay? But there's another site where they do both things, and this guy seems to sell a lot of trading methodologies, but he has his own robots, and he makes money from that and puts it into his robots. So he has it spread around. His robots are all diversified against a few different ones. See, the big thing is the entry costs are so low. It costs you nothing to set up the site, and you all do is you pay the spread. So when I talk about the 2 pip spread Euro US, that's what I get. Okay? 2 pips. You go and buy $1 at the bank, it'll cost you 200 pips. Okay, I mean, so this market is just, and there are people, and I'll show you later. There are people who, and I've met some of these people. There are people who just make a living from trading currencies from their computer at home. Okay. Okay. So I'll talk a bit about some of the methods later. Okay. So the currency, obviously, it's one unit in terms of another, and I think you're all pretty familiar. And generally they go to 4 decimal places. It's quite common for these broking firms to go to 5 decimal places. I can't really, the people that trade small movements in currency called scalpers, I don't do that, okay? So I don't know, so they've got 5 digits on many of them now, but it's a real nuisance when you want to change the price, when you've got the little arrow to tick, when you've got to go, so I don't know. So, and, 1 unit of the pound to the US is around here. So generally, if you deal with these currency, for instance, I'm quite familiar with, where the Aussie dollar is all the time, and I'm usually pretty familiar with the pound and the euro in just my general work environment. And that I know that the pound's a fantastic exchange rate on the pound. When I was in the UK last, it was half its rate now. Okay, it's double, and the Australian dollar is very strong against the euro, and I know that. Okay, so I'll do the one, and I'll do that first. Okay. Except, I'm talking about the one, the yen. I never put the yen first, okay? Because it will be 6 decimal places, and you don't want to deal with that, okay? So the yen's always 84 or 82, and it's how many yen there is to that other currency, and that's why they do that, okay? Okay, so this is a slide I showed you in the first class, okay? And this just shows the variability in the exchange rate. Now just point out something here, and this is very difficult to learn to do, okay, is that, when you think of this low here, right, you've got a low there and a low there, and even over that period of time of years, it's relatively close together, what they call a support position or an area of confluence. If you call it area of confluence, you're not specific, but it's an area here where the currency's gone down and dipped. Okay, now all the academics that I work with in this school reckon I'm bonkers doing this stuff. Okay, it's all a market that trades all the time. Okay, but my research shows there are particular behaviour patterns, and there's even other research that I've done that show that there are long-term cycles that you can predict as well. There are guys that can do that, and all they use is mathematics, right? I mean, I'm at the moment, all I'm doing in my trading now, after a lot, is just maths. So if there's a big announcement, I might not do anything, but what I'm trialling is doing it using mathematics, and I'll show you later how I might do it. So some of this research that I'm getting hold of was done some time ago, but people just don't know how to use it, right? So, and also these highs, you see, these highs, they stop. Why did it stop right on 0.8? Why 0.8? Because of what they call a big number. It stopped there a year later, right there. Okay, and here it stopped again there. Here it just did past and gone up very quickly. Okay, here it did stop for a short time. Okay, so, and here this is over a few months. Even daily, it's hit this level all the time. There's a resistance there. You can't get through it. And there's another really neat piece of software that I bought. Okay, I don't use it so much at the moment, but from a guy that was very good at doing this, American guy from Japan, Japanese name, Haru. His name is Haru Miyagi. Okay, and he developed a set of software. So if I draw a line here, I can activate his software. So if it breaks through and comes back, it buys for it to go up, right? So it's not a trading thing. So you set, if you can draw lines on a chart, you can use this software, and he does. Okay, it just didn't suit me. Okay, so there's some patterns there, and that's a 10-year chart. You can go down to any time zone you like. Okay, and that's the Australian dollar US. So that's the 1 year one. Okay, strike. Last year, 82. Gee. I haven't looked at it. Okay, see there, stop, there again, Okay, so that 92, okay, then just zips straight up, okay, and then has a trouble, and that's the highest it's been, I guess, okay. But having trouble around the $1 mark, you know, for obvious reasons, okay. And there's the euro. There's a bit more volatility, you know, within the ranges here for a long time.
You can see
okay.
that ceiling at 0.64.
You can see the ceiling at the, you know, it's more or less 1, 2, 3, 4, 5, 6. Okay, and then it even took a while, and I mean this is daily, so that's probably a couple of weeks anyway to do this to eventually break through it. Okay, then it jumps to the next level. Okay, so my research is in. Is just trying to develop methods that can do this, because I think that this technical stuff can help with the forecasting. I'll show you later what I've done recently, which I got right. Okay, so and these big numbers do matter, you know, like the point, that's a 6.4 must have been significant in the past, so they go back to see what's happened in the past. Okay,
And a floor at 0.54.
5.4. I think that's the Reserve Bank doing that, but anyway, that's handy to know that the Reserve Bank's going to come in at 5.4. You know, I mean, that's the best piece of information. Even though there must have been sleep here, right? But perhaps there were other reasons why they didn't do that. Okay, so it went down and then it floored. That would have been the Reserve Bank there, I reckon. And, so anyway, so you can see, and people think it's mumbo jumbo, but I do have a one of my colleagues who's a professor here. He's also done quite a bit of work in this area, and he did for a while ago because he used to teach the forecasting stuff. So he came across stuff that I'm just finding out about. Okay, and that's the Australian dollar euro, as you can see in the last year, you know, continue. But you know, the volatility is in there, isn't it? Okay, and what's that now? 7.4, and it's about, you know, look at that, 78. That's phenomenal. Anyway, you've got to cope with this when you do your assignment, you'll see. Okay. Okay, so depreciation, appreciation. There's some area where I'll hopefully I'll do this over the next few. Very important distinction that you need to make. Okay. So we're looking at currency can be difficult because you have to decide a period of time. Okay, that you're looking at. Okay. So here, in this case, Australian dollar is 99.20 to the US. It's, you know, was this week. And it's 99.50. Okay, so this means that for your Australian dollar, you get more US cents. Okay, so therefore, this means that the Australian dollar is appreciating, and obviously the other one's depreciating. Okay, so that's for that period of time that you're talking about. These 20 minus 50, this means it's 30 points more, so it's increased by 30 points. Okay, so 30, you know, on a trading account, you know, if you've got $1 million account, 30 points worth a lot of money. Okay. Okay, so why does trading come about for currencies? Okay, so there's three major reasons, and they're different, and whoever does it is different as well. Okay, the first one, as I mentioned last week, remember we did the futures contract and stuff, and we looked at hedging. Okay, so a lot of the transactions that take place in the currency market is to do with hedging, and the hedging is try and immunise ourselves against the currency movement, and it's easy to do that. Okay. I'll talk about the basic contract. It's a forward exchange contract. It's easy to do, but it fixes the exchange rate in the future, and you're locked in.
Yeah.
You're locked into that.
If it changes against you, then you just got to cope with it.
You've got to cope with it. It can move, you know, like everyone has a story where they bought the exchange rate and they should have waited another month. Okay? But if you're a business, then it's what suits your business. And I worked as a consultant in this area for about 4 years, I guess, and I actually have a whole, I'll go through some of it in this course, that myself and a guy who had worked in the New York currency markets, he worked for Citibank actually, with the lady who developed the whole foreign currency options market, and he taught me all this stuff, and we wrote a whole package. We have a whole course for businesses, but they couldn't understand it. But my students can. Okay, so hedging is a principal thing. So businesses do that. Okay, individuals might do that as well. Funds managers do it, even though it's a bit different for them. Okay, and the other is arbitrage. Okay, and I'll show you how to do an arbitrage. Right? No one's ever told me that they've ever seen an arbitrage in currency.
I think in different markets as well, especially like you were were saying in a market you might have a currency at a certain exchange, but if you buy it in another one, it's slightly different, so you speculate on the two different.
Okay, you could if you had both brokers side up, but there'd be a spread.
Or
You know?
less liquid
Yeah,
easy.
yeah.
We have done something with the major bank in Colombia, also trades in the New York Stock Exchange.
Yep.
Where is some difference between the two prices. We buy some stocks on the United States market and
Yeah.
sell it in the Colombian
Okay,
market.
yeah.
But you need to have good friends in both sides because you need to do all the trades.
And how fast?
Too fast.
How fast?
It's 30 minutes to do all the transactions.
Because that's
Buy
re-
there and sell in Colombia. And make
Can you do it is that done electronically?
Yeah.
Mm.
But you need really someone that is inside of each company to do it straight away because they have a huge amount of transactions, and you need someone to put your transaction just in the front.
In the front, okay. Well, okay, yeah.
That's almost
Yeah. What you're saying there is there's because look, electronically,
It's huge.
I can do it in a minute.
No, but
I could buy it and sell it in a minute. Okay,
Yeah,
or
yeah.
less, 30 seconds, as long as it takes me to type it in. Okay, you can do it. So what you're talking there is the market is not that efficient, is it? It's in the Colombian currency. What's that called?
It's local, and when it has some difference between the currency,
Yeah.
the United States and Colombian peso,
Yeah.
there is some difference.
Yeah.
For example, one stock in Colombia costs you $100,
Yeah.
but the difference between the currencies give you a gap,
Yep.
and then you buy it.
Yeah, okay, so I can do it. Well, there we are. There's an example of an arbitrage, you know? Okay, but it's within currencies are not heavily traded. They're illiquid markets, okay? And perhaps you have some insider knowledge about what you would think has been the movement. If it consistently happens, then obviously there's a trading edge. But in these major currencies, I can't see how you can do it because there's a spread there, even though that spread the currency just, they have software that, if there's an arbitrage there, the banks will be trawling through software that trawls through looking for these gaps. As soon as it finds the gap, it automatically does it. So essentially, that means that there won't be any gaps because they're so efficient. Okay, so it's fast. The way that you can do arbitrage, obviously, is when markets are lit. I mentioned, I think the property market is a great arbitrage market. Okay, because there's different information. Information is valuable. Okay, new freeway being built, that's valuable. Buy property near new freeways. It stands to reason if you know in advance. And it's good. People who bought property, I know some, on the outskirts of Melbourne 10 years ago for, let's say, $200,000, worth $2 million now. Okay, so, perhaps they knew something. Were they government officials? No, nothing like that happened. Okay, then obviously the speculators, okay? So there's a lot of criticism of the speculator, okay? So I guess that would sit with me as a speculator, but what I try and do is what I have to do is to learn enough that I'm not a speculator, is that my probability is 90% of getting it correct. Okay, so that's what I strive to do, okay? Or I have it set up so if I'm correct half the time, if I'm correct 50% of the time, then the way I have the transaction set up, I would always make a profit, okay? So, and I did that last week, okay? Okay.
Can I ask you something?
Yes?
Speculators, we heard a lot talking about them, especially lately, also in Europe and against the yen. But to be really effective, you have to be a fund, a hedge fund, because individual cannot affect even minimally currency. So the real one that affects majorly currency,
Yeah, you're correct. Yeah.
Organization.
They can move these hedge funds through incredible leverage as well. They can move markets themselves. The famous one is George Soros.
Market could be manipulated easily.
Yeah.
Compared to huge.
Well, you got government. If you got government involved, and
For a government, is not easy to manipulate a market.
Sorry?
Sometimes it's not easy.
Yeah, it's not easy. They might.
Bank to manipulate.
Yeah. So I mean, even for the big players, it's open. Even though there must be transactions that go over the counter or under the counter, if you like. But I think it's more difficult. But information is valuable. If you know that a country is going to buy or sell a currency, if you have that information. See what happens here in Australia, and it happens many times, except it didn't happen with the most recent treasurers. When you get a new government here and a new treasurer, within 6 months they go on a visit to the United States and they get interviews. What are you doing with the Australian dollar? Oh, we're going to support the Aussie dollar. Well, gee, as soon as they say that, everyone starts buying it. Okay, and then they should keep their mouth shut. Okay, the famous, and I can tell you this. I can look at the exchange market, Australian dollar, US dollar, and I can tell you it's 1985. Now it's outside a hotel called the Plaza Hotel in New York. And it was where they said that they were going to support the Aussie dollar, it must have been, right? Sell the US. Because then it plummets, then it moves. Okay, 85. I was in Canada then. It must have gone the other way because the Australian dollar weakened when I was working there. Okay, so I worked in Canada in 1985 and I was paid in Australian dollars. I worked there for a year. Okay, and over the year my salary went down by 20%. Okay, so what I did, it was really quite convenient, is the Australian tax year and the Canadian tax year was split. Okay. So what I was able to do is, because I was able to split the Canadian tax year up into 2 half years, I was able to reduce my income, because just for half a year, get down to a lower tax level. Then I told them, I said, well, what exchange rate do you want to choose? And they said, well, whatever you like. So I went through and checked every month, and I put in the lowest possible exchange rate that was on a screen. Okay, so I got my income as low as possible. So I paid as little tax as I possibly could, and they quite accepted that. Okay, I just didn't choose one rate for the year, but I did it for a monthly basis, right? To offset what I lost on the exchange rate. So instead of losing 20%, I probably only lost 15. I lost 5. But that was because they split the tax years up. Okay, so the speculators, it's a big market. These hedge funds do it. They'll move the market. You have to be very wary, but obviously they have people. There are people, and I saw it amongst my friend who taught me some of this stuff. And at particular times, he just was in a zone where he could pick where it was going, and he just phenomenal record for a month. And then he wouldn't trade. He'd stop trading. And he'd get in the zone where he just felt that he could see what was happening. Okay. And if you can read charts, you can read patterns and so on, you can do this. Okay? So these are the types of transactions, and the one I've been talking about most here is called the spot. Okay? Okay, is called the spot. The forward we'll talk about, that's the one I'll do a bit later. The outright forward is just another name for it. Currency futures, very little in currency futures compared with the over-the-counter spot market and forward market. But currency futures are traded in those markets I mentioned last week in Chicago and Philadelphia. You might have seen me on DSO. There's a PHLX, which is the Philadelphia Exchange, does currency futures. Okay, and then we'll do swaps. I'm not going to do currency swaps though, but swaps are done with interest rates at the end of the course. And I'm going to spend a fair bit of time on the currency option. Foreign currency options, it's interesting, and that's what the spreadsheets are to do. And I'll load up the program this week with I'm just rewriting the user manual, and I'll go through that. I think it's next week. Okay. So when options, we're doing calls and puts. So you might be a bit wary of what I'm doing here, but with the currency options, I'm not going to do the theory of pricing them. Okay, it requires a whole 10 weeks to do it, if you like. But I have a model, and I can show you how they price them. We can work out the price using this model. It's very accurate. And I can also got this software so you can see if we change variables what's happened. And that's what I want you to understand. But you know, if you want to, you can go. I've got a paper on the formula if you want to read it, right? But it took us a few months to do that because we could only find one article that gave us the proper formula. Okay.
Is it Black-Scholes they use?
It's a variation of Black-Scholes. Okay.
Is it you use Black-Scholes for
Stock options.
stocks?
Mm.
Yeah. All right.
So look, Scott, isn't it?
Yes.
Yeah, Scott. So it's all the option models are derivatives of Black-Scholes in some way, except the binomial method, okay, which is a different one, okay. So essentially, what happens is in the standard Black-Scholes model, it's got a dividend on it, and it's got one interest, okay, interest rate. Now in the currency one, there's no dividends, but there's two interest rates. So that's the things we have to adjust for, okay. Everything else is the same, okay. Uses normal distribution and so on. It's called the Garman-Colhagen model, and I've checked it against the bank models because I did have a I got one of the pricing packages, okay, from a banking friend, so I was able to check it. You know, it was just about approximates the bank ones. There's a website called Fenics. I'll put it up, F-E-N-I-C-S. But I'll talk about that next week. Okay. Okay. So I'll do the calls and the puts. Okay. And then I'll show you some of the exotic ones. So I won't go through every one of this, but I'm going to look at these barrier ones. I actually have that on my pricing package as well. These are a big growth area, these options. They're quite unusual. Seem unusual, but I can show you how they work. Okay? And you've got these other ones. Okay? Digitals, ratios. So look, you can invent all sorts of variations with these derivatives. Okay, you can price all variations. Okay, and what my skill for some time was, for companies who the bank gave them this product, and the company would buy it, and then what I'd do is I'd get this product and strip it apart to see it's broken up to this type of option, that type of option, that type, and the bank's adding on a 20% margin for every one of these options. So you could buy them individually for $10,000, but you buy them as a package, it's cost you $18,000 because you don't know what you're buying. Okay, so that was my skill in doing that. Some of them quite complex. Okay, the last one also, and it is in the study guide, somewhat abbreviated in the study guide, but a good set of slides on this product called a non-deliverable forward. It's also in your assignment as well, and that's a particular forward contract which operates in regions of the world where they don't have a forward market. Okay, so you can't buy the currency using a 30-day forward exchange rate. You know, it's particularly used in Asia, okay, and South America, okay, because they don't have, you know, really liquid forward markets. So they use this other instrument. You know, a lot of them are done in Singapore, okay. Okay, so I won't take long here. So you're familiar with the indirect quote. Okay, the first currency would go first. Okay, sometimes called the commodity currency as well, and the other one's a terms currency. Okay, so I'm going to quote. Okay, that's a direct quote, which is the Australian dollar to the US dollar would be this. Okay, so I just do it one way all the time, then I don't get confused, and hopefully you don't as well. Okay, so the international practice, okay, is to quote the Australian dollar first. Okay, international practice everywhere. The euro US dollar is quoted like that, euro US. Okay, everywhere. Okay, just that weight. I've never seen it quoted the other way around. Okay, so I'm using the quoting that's done on the exchanges. Okay, not what necessarily in the textbook. Okay, the other thing I might point out, I've got the yen here. Okay, now it's really strange. Of the major currencies, okay, pound, US dollar, euro, yen, right? The yen is the most volatile currency. Okay, the yen is the one that moves the most. Okay, so if you use volatility, one measure of volatility is, you know, the standard formula, right? The other measure of volatility is what's the average move from high to low in a day of a currency, and you'll find the yen pairs always the biggest mover. The biggest mover is this currency called the pound yen. I call it the dragon. It just goes down, bang, it goes up. I mean, I don't know. All right, so I more or less, there's some people that do not trade that currency because it seems much more unpredictable. While traders will say that the best currency to trade is the euro US and the pound US because they move a bit more slowly and they sort of repeat the patterns all the time. Okay, so you'll find that just about every one of these robots will have euro US. Okay, because it's more predictable. But the one that I've had that's successful does the pound yen, okay, and the pound US dollar. Okay. So in practice, these are how they're quoted, okay? You know, in practice that means on exchanges, okay? So that's the main one and that's next, okay? US chef, US yen, euro pound, euro quoted first, pound yen, euro yen, euro Aussie. Okay, for ease of use, you know, within this course, I put the Australian dollar first because we use it a lot, right? But internationally, it's like this. But here in Australia, we tend to put the Aussie first, okay? But on the exchanges, it's euro Aussie, okay? Euro Aussie, which is about 1.6, I think, okay? Okay, so what this is an extract from Oz4X. Oz4X is where I get this data from. Okay, and what I'm saying here is that this is the spread in the market. Okay, this is Australian dollar, US dollar, 9178, 9184. Okay, so that's a 6-point spread. Okay, just in the last digit is we see the spread. Okay, now on broker side that usually goes down to about 4. Okay, I've seen it as low as 4. Okay, and the US Canadian, funnily enough, this is a 5-point spread. Chef 5. Okay, it would obviously be in the afternoon here when I got these rates, and they're not ones last week. But it would have been when the Japanese markets opened. The spreads are always a bit wider, so it depends on the time of day. Because I told you that I checked the spread this morning at 10, and I checked it again at 5:30 today, and it was down to 6. Okay, and that's because the market. So from there, so we've got the US CAD, and then we can work out the dollar CAD. So that's the cross rate. So you see in this cross rates here, okay. It's actually hasn't got the US dollar in it, but we've used the US dollar Hong Kong to work out the Aussie dollar Hong Kong. Okay, this is a fixed rate. Okay, NOK, what's that?
Norwegian kroner.
Pardon?
Norwegian kroner.
Norwegian. Okay, Norwegian kroners. Okay, NOR, good. Got a great retirement plan in Norway. All their oil gets. Everyone, a country invests all their oil in the Norwegians' retirement plan. Norwegians, when they retire, have so much money. Most successful one in the world. We try to do something here in Australia called a mining tax, but the mining companies wouldn't let us do it. We dig everything up and send it over. The Norwegians reinvest it all. Okay. So there is the US dollar, and that's the South African rand. Big changes in that one. Okay. Is there any Zimbabwean students here? Anyone from Zimbabwe? Okay, good. Okay, Zimbabwe now uses a dollar. They use the dollar because their own exchange rate was just phenomenally bad.
The US dollar.
Yeah, they use the US dollar. Mugabe would hate the US, but it's like Venezuela. Chevelle. Is it Chevelle hates the US, but they use the US dollar. Yeah. Chavez, isn't it? Chavez. Okay, so that's another one from an earlier period of time. Same sort of thing. Okay, so we use that's often the spread. That's the market spread. Also, what happens is within, because there's these brokers around, it's a bit different. But generally, you'll find that the currency market, any rate you can see on any broker site, there'll be another exchange rate that banks use that will be lower. Okay, so trading between banks, you'll get a lower exchange rate than outside. The spread sort of widens. Okay, so the banks trade amongst themselves with very low spreads, and they trade amongst themselves all the time. So obviously there's this bid-offer spread, okay? And here it's 95-20, 95-30. It's a 10-point spread, okay? So you know yourself, when you're international students, you bought Australian dollars, there's a spread. The worst place to buy currency is at Tullamarine Airport, because they got you. Okay, the rates are really bad, but there's not much difference here in Melbourne as well. But whatever it is, you know, that's a small percentage, 0.02% probably, while if I buy currency from my local bank, I'll pay, that's 0.02%, you know, like it's quite high. Credit card ones, I used to find the credit card ones were not too bad, but nowadays the banks seem to have ordinary rates. It's good to check when you do your credit card, if it's international, and see what rate they came up with. You'll find a bit of difference, okay? But the banks have big systems, they employ a lot of people, you've got to pay for it. So you've got the bid offer, and then you've got the spread, okay, between the two. The bank makes a spread, okay? These brokers that I'm alluding to, they just love transactions. Every transaction they make money, right? So they don't have a lot of people there working for them. You know, it's just an electronic system. You know, the quality of what they do is reflected on how good their servers are, and that their system doesn't go down, okay? Okay, so that's just more information there, okay? So there's just an example of the spreads, okay? Okay, I mentioned the cross rate before. So the cross rate uses the US dollar, but it won't include the US dollar in it, you know? So you can do a three-way workout, and you can work out what the exchange rates are, okay? What they should be. So here's a cross rate calculation. So I've gone 1 US, 1 Aussie to the US, okay? Better put it out here. Oh, here we go. 1 US to the Aussie and 1 US to the Euro. Therefore, that Aussie dollar and that Euro must be the same. Okay? Right, you okay with that? So that's 1 US is that many Aussie dollars? Okay? 1 US dollar is that much Euro. Therefore, they must be equal to one another. And then I divide both sides by this amount to get this to 1. And I can get 1 Aussie dollar is 59 euros. Okay?
So you just divide the two US rates in the first one?
Yeah, you could do it like that as well. Yeah, I just. Well, this is year 9 maths. I've just done it slower, but you're right. You can do that.
But
Yeah.
if you divided both first ones by 1.0869, you're not going to get one of them equal to 1.
No, but you can do 0.92 divided 1 by 5. Yeah. If you do 0.92 divided 1 by 5, you get it straight away.
Okay.
Yeah. So you can just sit down and work it out.
How did we calculate these USD we have from given?
Yeah, you're just given those. Yeah. So you're given those, you can see them. Look, I mean that's how they work it out. But if you've got a broker site, you can just look at it. You know. But essentially that will work out. Okay. Time's gone by, they would have had to work it out. Okay. Yeah. In some countries in the world there are money changers all the time that do it in their head. Okay? I mean they don't have a calculator, they just do it. It's phenomenal.
Yeah, I've had this stuff on previous exams, and this is always been hard.
Okay, well I'll talk with you about it.
It's so easy to
You get it round the wrong way.
yeah, especially when there's really complex yen in there that you find.
Is the same, you divide.
Yeah.
If the local currency is the same, you multiply.
Yeah.
And otherwise you do the long way.
Okay, well I must say I know that this must be,
Yeah,
it must be around 60 sort of. Yeah. Okay. So anyway, look, I'll set up some practice questions so you can do that. Okay. I'll do that. Okay, so what happens is obviously the bid-ask spread, and when you work out these forward rates, okay, so when I want to exchange the currency in 90 days' time and I want to fix an exchange rate now, there's these points that changes over the period of time, okay, and this is the Aussie US dollar. So in 1 month, whatever the spot rate is today, the forward exchange contract rate for 30 days, you'll have to subtract these numbers from it, okay? So effectively it goes down like this, okay? And as you go from 1, 2, 3, 6, 12 months, you'll see that the exchange rate Okay, the spot's 90.65, 90.70, and to find the 12-month forward, I'd subtract this much money from this one here, okay, and I'd subtract this much from this one here.
And that will be the forward.
And that will give me the forward, yeah, and that will give me the forward, okay? Yeah. So the thing is that this is the interest rate parity thing, okay, and this is a formula. Just use the formula, all right, and everyone will use that formula, okay? Okay. So you have the spot rate, and then you adjust for the forward points. So what happens? I might ring the bank up and say, look, I want to buy money in 30 days' time. Can you give me the rate today? And they'll just say it's 10.15. Okay. So what I do there with that 10.15, I have to know whether I'm going to add or subtract, right? And then I just add it or subtract it from the spot rate. Okay. Because they won't give you the actual rate. It's easy to say 20.30 than 90.20, 90.30 sort of. They just give you the last two digits, okay, which in that previous one, okay, would have been, okay, here I've got a few more actually, right? So they can do that. They just call that out if you like. But nowadays, I don't do that because if you're a company trading with the banks and buying foreign currency, you do that on the website. They give you the forward rates on the web, and you can do the transaction. The banks have got this service now. Instead of them having to on the phone and stuff like this, you can do the transaction for forwards and all sorts of things. So the banks have done that now. Okay. So the forward market. So you can go to Oz4X, okay, and you can go in there and you can work and you can get the forwards. You can see. Okay, now there's the interesting thing with the forwards, and I'll explain it now, is the forward rate is just a formula. You just have a spot rate and you have two interest rates, the foreign currency, the domestic currency interest rate, the risk-free rate, and that you just do the calculation, you adjust it for the number of days, and that tells you the forward rate. Okay, it's interest rate parity. It's not it's a theoretical concept that works in practice. There's no doubt about it, okay? Because that's how the markets work. It's a very strong, what we call parity relationship. Okay, when that gets out of parity, then you can arbitrage, okay? All right? So you can, from Oz4X, you can get the 4 points, and I'll show you how the formula works, the formula that I use, and I've also got a little spreadsheet that you can get onto DSO now. You can get this spreadsheet, and you just got to put in the spot, the forwards, the time period, just the number of days. It works it out for you, and then you can run it through the formula and just check if that's right. Okay, so it's instantaneous. The input data is more difficult to get. Oh, not so. One, the spot rate's easy to identify. The interest rate's a bit less so, because really the interest rates are the risk-free rates. Okay, so I know here in Australia it's 5.75, but you have to adjust the interest rate to the time period. Okay, so I think the 30-day rate's 5.75, the yearly rate might be 5.8. I don't know. You've got to go to the Reserve Bank to find that, but you can just put in the risk-free rate, and that will give you the forward points. Okay, for some countries it's more difficult. Okay, I'll explain why that happens. Okay. So this is the interest rate parity. Okay, so just think here, I'm just using indirect quotes. The Australian dollar is 1. Okay, if it was quoted the other way, I'll have to reverse the whole formula. It would just be around the other way. Okay, so I just do it like this. The spreadsheet does it like this as well. So the formula is that the forward rate divided by the spot rate equals 1 plus, this is I, right? My computer won't give me a small I. It's capitalised it all the time, right? So, right? In brackets I've gone foreign. I've just used foreign, okay? And here it's 1 plus I again, domestic, okay? So the forward over the spot equals 1 plus the interest rate foreign over 1 plus the interest rate domestic. Now this relationship, it's called interest rate parity, it's very strong, very strong. Look, if this didn't work, I would not be here. I would be a millionaire many times over if this did not work. Right? And in fact, when I was a consultant, we were approached by some recently retired bankers of how to do it. They could get a whole lot of yen really cheap, and they wanted to take it to the US and do what we call the carry trade without taking any risk. Okay, so the carry trade means that I borrow the money in Japan for zero, and I lend it. This is going back a couple of years. A good example now is this. I borrow the money in Japan for 0%, or they'll probably charge me 1%. Okay, $10 million. Doesn't cost me much for a year. All right, and then I can invest that here in a bank. I think it's 7% at the moment. Right? So I borrow the 10 million at 1%, and I invest it here at 7%. Right, so I make 6% profit. I make 6% profit if the exchange rate stays the same. So if when I've got to pay the money back, the exchange rate the same, I'll guarantee I'll make 6% profit. Okay. Now, if that was true, everyone would do it. But the exchange rate changes, doesn't it? It might go one way where I make 12%, and might go the other way where I might minus 6%. So it's just as likely to go the other way. So I say, why don't I hedge it? All right, I buy the forward exchange contract. As soon as I buy the forward exchange contract, the interest rate differential on the forward points is gone. I don't make any money out of it. They wanted us to beat that system. Unless, how could it work? I worked out how it could work, but you have to be in different markets. For instance, this works using what is the interest rates. If you could get instead of this 7% in Australia, you could get 8%, and you can hedge it using 7%, then you can make 1%. Okay? Okay, so if in the formula the interest rates were different to what you get in the marketplace, you might be able to do it. Okay? But it just balances out, because everyone would do it, and therefore the market reacts to that. Okay? So in practice, interest rate means that I cannot borrow in Japan at 1%, invest in Australia, hedge with the forward, so I'm fixing the payments in the future, because I've got to pay the money back plus the interest, and then make a profit. Why? The hedge instrument offsets the interest rate differential. Okay? So it holds up. It's very true. If you don't use it, you take a big risk. But hedge funds have been known to do this carry trade. When the US interest rate was 4 or 5% and Japan was much lower, then they would borrow in Japan and lend in the United States. As long as the exchange rate didn't move against them, they would be okay. So you'd have to watch it. So what happens in practice is that once the yen would start to appreciate, so it means that I've got my US dollars, I've got to buy yen to pay back the loan, I'm having to pay back more and more. Eventually all these hedge funds would start to liquidate their positions and buy yen. So once they start buying the yen, so does someone else, and it keeps going up again. Okay?
Even worse.
Even worse. It'll overshoot then. Okay? So I'm sure that there will be trades now where that's an interesting call, that one. Okay, yeah. Okay. So, okay, so the way to do it at the moment would be with the Aussie dollar. Okay, so as long as the Aussie dollar appreciates against the yen, you're safe. But they'd move big amounts of money to do this. Okay, so here's an example. Okay, and this is using the data at the moment. Okay. So in March 2011, the market rates were, one Australian dollar is 0.9965 US. Okay, the 1 year Australian US interest rate's 0.5%. Okay, 0.05. In the just for completeness, the US calculates interest rates on 360 days. Most countries do, except for any country associated with the United Kingdom, like Canada, Australia. Well, certainly Australia anyway. We use 365, but just to find a difference, it matters to banks because it's a couple of cents, but I'm not too worried about it here. But the rate here is 5.75, okay? Okay, the difference, there's a difference, okay? So if I put the formula, I'll just adjust that formula a little bit, okay? I take the S out, is this times that plus that. This is for 1 year. Now, if it was for 30 days, I'd have to multiply just this part here by 30 over 365 or something, yeah, for the foreign rate, okay? Remember I have to adjust it for the time period, right? So if I had the 30-day rate, the 30-day rate is 5.75, let's say the yearly rate's 5.75, but if I'm using it for 30 days, I have to divide the 5.75 and multiply it by 30 over 365, okay? Yeah, and the American will be 360, yeah. And the other one will be 30 over 365, yeah. But I have to just multiply the last numbers here. It's only the interest rate, it's not the 1 plus. I've had students do it to this one and they get some very unusual results, okay? So just do that. So I've done it for a year so we don't have to worry, but I'll do a whole series of questions for you, okay? So the forward rate is 94.70. That's incredible forward rate. That's 490 points. So that means if I want to hedge this transaction, if it's 99.65 now, and I want to buy a forward exchange contract to exchange the money in 12 months, and I want to fix it with the bank, it's going to cost me 9470. Right? Now, if I am an importer, that's 490 points against me, really. So importers might not hedge much because it's, at the moment the differential is as bad as it's ever been. Okay, right? So if you're an exporter, you might not use the forward because it's working to your favour. You know, I mean, you would use the forward, okay, because it's a better rate for you. Yeah, good. So in practice, you know, over time, the interest rate between Australia and the United States have been not the same, but within probably 2 percentage points. If one's 6, the other's 8. You know, this is a big shift. So there's big movements in the forwards. It's unusual to have that. Okay, all right. So that's a lot of forward points there, and importers can fix that rate. Well, they might be prepared to say that in a year's time the Australian dollar won't drop by 490 points. Okay. So they might wait. So you know, I don't know what their behaviour, but I can see what their behaviour would be. Okay, they just wouldn't be hedging. Okay, and that's because the differential's so great. Okay. Okay. All right. So it's called. Okay. So the other thing to note here is that which country has got the highest interest rate? It's Australia, isn't it? Okay.
At the moment.
At the moment, it's got the highest interest rate. Okay.
Developed.
Yeah. In this case, it's just Australia. Okay. Is higher than United States. Okay. And it's higher than everyone except New Zealand. Right. In the developed countries, I think. Okay. So if the Australian dollar weakens, okay. So the Australian dollar is actually weakening in the forward market. Okay. So in the spot market, I can get 99.65, and in the forward market, I can only get 94.70. So the Australian dollar is weakening in the forward market. Okay, and that's because the interest rate's higher. Okay. So it's not. I'm not telling you what's going to be the spot rate. 12 months time. So I don't know what it's going to be. But I can tell you what's going to be the forward rate because I do the calculation. And the banks use this calculation. Okay, look, it's...
So that's why you say you can't make a profit on the foreign market.
Yeah, because the interest rate. Because the only way to do it is if the interest rates are segmented, that is. And what I did this, right, and I said, well, the forward rate assumes the risk-free rate. So I did an investigation, and that's the rate they use. But if I'm able to use a different interest rate to hedge it, but I can earn 10% here instead of 7.4, but generally if I'm earning 10%, I've got other risks associated with that higher interest rate. So that might balance it out. Sorry, Scott?
You'd be best investing like an index fund or something. I mean, that's going to be higher higher than the rate on Treasury bills, and it's going to be fairly safe if it's trapped.
Well, yes. I mean, that's the search for yield is the case, because in the US it's very low interest rates. So, I mean, but you know, there's different types of interest rates. So I can obviously borrow at low, but if theoretically I say it's at the same risk level, I can't. But if I'm prepared and I've got where I can get 10% and I'm sure that they're going to pay, then it would be, I could do it. If you could do it. Okay, look, we'll have a break here, okay? Okay, it's 8, I think. It's 8, so I have a 10-minute break, all right?
I understand that statement, like using the interest rate parity.
Yes.
Which you said, like Japan gives 1% interest, you deposit it somewhere else,
Yeah.
and then you buy a forward contract.
Yeah.
How come that doesn't result in a profit? Like, I know that like there is an
Because-
exchange rate risk and the interest rate risk as well.
No, it's because once you buy the forward contract, okay, the forward contract within that forward contract that allows for the interest differential and adjusts for the interest differential. Okay, so the forward contract, which is a hedge instrument,
Yeah.
is calculated using those interest rates, and that adjusts for the interest rate. So therefore you can't make any money out of it.
But the interest rate risks are like they are adjusted, like, but we have to take into consideration the foreign exchange risk. That is.
Yeah.
That's what you do.
Yeah. So if I want to hedge out the foreign exchange risk, I can't make any money on it, on the interest rate differential. Okay? If I don't want to worry about the foreign currency risk, then yes, you can make it.
Like this is why like forward rates take into like, consideration the interest rates. Because
Yeah,
of this formula.
yeah, because the formula. Yeah, this formula here. See, there's the two interest rates. Okay, that's how they calculate it.
That's how hedge.
Yeah. So if I want to hedge it, so if you're a business and you're buying currency, then you'd hedge that. I'm just saying that some people try and buy the cheap currency, hedge it. But if the Australian dollar goes down, you know, goes down by more than this, okay, you didn't hedge it, then you would lose compared to this one here. Or even if it goes down a little bit, you lose compared to that. So you have to decide the risk.
So like it's more beneficial if the domestic currency interest rates increases.
It's not beneficial to anyone. I mean, if I'm a lender, it's good. If I'm a buyer, it's not. Is it?
But if I'm a lender, then if the domestic rate increases, then it's good for me. Like.
Yeah, it's good for you. As long as. But what happens with interest rates is if you're banks, you have to borrow the money, or people deposit money.
Yeah.
So I pay you 2% to put in my bank, and I'll lend it out at 7%. It's not a good deal. It's a big spread, but the bank spreads are about 2.5%. They manage that spread. So as interest rates go up, they have to.
The lending rates also go
It
up.
goes up like this.
Yeah.
But often what the banks do is they always increase the rates they lend at before they increase the rates they pay to people. Yeah. Always a bit ahead and it catches up.
One more thing, like it's for general knowledge, like the Reserve Bank of Australia doesn't intervene that much in currency because I'm from India. Recently there was an increase in the percentage lending rates from the Reserve Bank of India.
Yeah, well here they
25 basis points actually.
Yeah, well here they do that. You go back to Reserve Bank, you'll see that they increased it until November last year. They were increasing it every 60 days by 0.25 basis points.
because like back home they are trying to keep the inflation under check. So
Yeah,
that's why
it's the
they
same
are
thing here.
increasing.
Same thing. So what's the interest rate in India?
6.25, I guess.
Okay, so here it's 5.75, so it's not much different. And it's going for the same reason, is to keep it's a primary policy is to keep inflation in check.
I'm still like I wasn't totally clear with that concept back like they were increasing the interest rates.
Yeah, that's why they're doing it to keep the inflation. But I don't like it because it hurts everyone.
Yeah, it's
You got the business that's struggling and they go out of business, or the farmer that
yeah, because funds
borrowing a
are
whole
pretty
lot of
costly to
money.
come back.
Pardon?
Funds are pretty hard to come back for poor people actually.
Yes, yes. So they catches all them out. And, yeah, I agree with you. It's indiscriminate. Everyone gets caught.
That's it.
Okay.
After a while, I went to go back inside, and outside my house there's an ancient with sort of a ditch, filling water. I sort of leapt over it, but when I landed, where you got your ankle right back, landed like that, but I couldn't sort of shit right stuff. And so, oh yeah, but it was ligaments, yeah. I went to the hospital, it was really painful, so I went to the hospital. No broken bones or anything, but that's what it looked like. Yeah, swollen. This was it's still swelling. Yeah, it's bruised. Yeah. Well, the ambulance had left before I realised how bad it was. I thought I just hurt my ankle. I get inside and look at the thing, it's like I've got a tendon on my foot there. Yeah. Oh, the Western missing. I mean, a bit of pain. Losing my footage. I went to the airport. I worked at there's a company there. And so they used to employ like because yeah, actual it's the airport.
Okay, all right, then I'll just continue, and looks like I had the recording mixed up, so I'll record the lecture tomorrow. I'll have to record it with a Zoom. Okay, so I'll just complete now, but I'll run the recording for the last part. Okay, yep, they can hear me now. All right, so this is the formula that you use, okay? So the way, if you look in the study guide, you'll see I've worked a few problems of how it works, okay? Obviously, if the formula we'll use, it depends on what your bank. They might add on a risk rating because of your business. You know, it can be quite different. But in the perfect market, they're the rates they will use. But if they think that you're a risk with these forward exchange contracts, they might give you a different rate because they put in a risk premium. Okay, but if you could get the forward contract locked into this exchange rate, these interest rates, and actually within Australia you could earn 7%, then you do have an arbitrage. But it's a different risk. Okay, so risk for risk you can't do it, but if you're prepared to take a different risk and perhaps you can manage that risk very well, then you could do it. Okay? Okay, so that will be the difference. So the forward discount or premium means that if the Australian dollar weakens in the forward market, right, so that means you use a forward exchange contract. The contract's just a piece of paper. Okay, it says today's exchange rate, says the amount of money and when you have to pay it back and what exchange rate they're using. That's all it is. Very common instrument. You can probably do it for as low as $25,000 depending on what the banks want to do, or you can do it for millions and millions of dollars. The banks don't mind because they always get the money in to do it and they make the spread. You know, and it's the larger the amount of money, the better for the bank. Okay. Banks might specialise in particular currency pairs though, right? So as the thing to remember that as the Australian interest rates are higher than just about every major developed country in the world except New Zealand, okay, then its currency must depreciate, that is at a discount in the forward market. Okay. The currencies with the lowest interest rate, which are Japan and the United States, their currencies will appreciate or at a premium in the forward market, and it's all to do with just the interest rate differences. It's nothing to do whether you think it's a good economy or bad economy. It's nothing like that at all. All it is the interest rates. Okay, very strong parity relationship. Notice this point here, the second dot point. Okay, important to note that the forward rate is fixed. It is not an expected spot rate. Okay, it's not the expected spot rate. Okay, forward rate is a fixed rate, calculated according to today's spot and the interest rates. Okay, just that's all it is. But it is generally, research shows that is a pretty good predictor of the future rate.
Russell, you can have a number of the volume of the number of forward contracts that have been done in the last week in that forward rate, and that will give you if the company are expecting or not that forward rate in 12 months, and give you an idea what the companies are expecting about the evaluation or valuation against US dollars. That give you an idea,
like what, for the bank or something?
Yeah, if they, because
well, it's just a hedge, just whether whether you're going to hedge or not.
If they are not taking that forward rate,
yeah,
they are thinking in a different way, and because the forward rate is considering a depreciation.
Yes, yes.
Probably if they are not taking that forward rate, they are thinking in a appreciation.
Yeah.
Then you can have an idea what is the big company, the big player thinking in
okay.
12 months, right?
Okay, good. Yeah, what Aliando is saying is that that I guess if companies reduce their hedging, then they're telling us that they have some view on the market. So if I was a bank and I had a whole series of importers, okay, who didn't like the forwards because it gives them a worse exchange rate than the spot rate, then their view would be that the exchange rate's going to go up, yes. So that might give me some more information. But, who's a good predictor. The bank's not always. Right? Everyone will get it right in the end. Right? There are banks out there that said the Australian dollar was going to go to $1 for the last 3 years. Right? Got it right last year. Everyone can have a view. I can give you a view, right? You can have a view. Everyone can, right? But collectively, all the importers are not hedging. Then obviously, sooner or later, they're going to have to exchange the money. So if a lot are doing that, that is telling you information that they expect it to go higher. Yeah. And when you're thinking of bias at the moment within Australia, with the Chinese economy still going, but Australia has a lot of yen sort of work, but you might think that it is going to go up. Yeah. It hasn't really stopped. Okay. So the lower interest rate will be at the premium. Okay. Okay. So what the foreign currency does, and what I want to show you over this series of seminars is a currency adds another question to the occasion. Okay. And it's not something companies can control their manufacturing process, their marketing process, their sales process, all those things they can control. They cannot control the exchange rate. They can fix it, they cannot control it. What happens is you get people, very skilled business people, try to analyse the exchange rates. Right? It is difficult to do. Okay. Look, I've been working at it for 2 years myself, right? And 5% of people can do it. 95 fail. Okay, it is difficult to do because it's very unpredictable, like what's happened in Libya, what's happened in Japan within the last 3 weeks. Okay, they're not picked up in the currency markets, and they react very quickly. Okay, I received an email on the weekend saying that this trader predicted, he set up these cells on I think it was the US that dropped. The yen dropped and then it went back up again. Okay? And he said that he recommended all these cells and they went for 5 cents or something. Well, he's just lucky. Right? He had a sell order in. He didn't predict what was going to happen because he didn't know it was going to have an earthquake and that. But the market moved and he said his method made 500 pips. Oh, it's a rip-off. Right? But that's what you get. But if you had followed his methodology and you did that, well, you'd be right. But my view, it's a guess. Okay. Okay. So so the volatility is important. So you don't worry about this too much in China, obviously. Okay. But the thing is that the currencies are still floating against the yen. It doesn't matter internally in China, but externally it does. So who's responsible for it? You might have a board of directors that think they know all about currency. I once invested somewhere and I made a whole lot of money, right? Look, I tell you what, I killed the market in 1970, okay? I was a student like yourself and I was travelling in New Zealand and I had 100 Australian dollars. And they revalued the Australian dollar by 10%. I made $10. Right? $10. Gough Whitlam did it, right? Killed the market. $10 went a long way then, okay? So, why did it happen? I didn't know what the government was going to do. I just happened to have Australian dollars and I was in New Zealand on a holiday, right? Like 10%, right? Okay, invoice hedging is a way where you get an invoice and then you do the forward exchange contract. It's very standard. Many companies do it. You can take a guess. I've met companies that turn over $20 million in foreign currency. That is, they need $20 million a year in US dollars, say. But they turn over $100 million in their currency account. It's because they're punting the market all the time, right? And they only tell you when they win. Right?
Yeah.
Okay. So what I want to teach you is some of the modern techniques. Okay. So what you can do, right? It has within a time period and under certain circumstances. But I'll show you how you can manage the risk and perhaps benefit when it works in your favour. Okay. So these are the types of different operating exposure, and we're really going to focus on the second one and the fourth one here. So the first one is like what we call operating exposure, and essentially that means that if I have a manufacturing business and it's in China, then I have currency risk. If it's in Indonesia or Malaysia or Thailand, I have currency risk, right? It's because I'm operating in that country. Okay, and also I've got the risk of the wage structure and the regulations and everything like that are different. So if I'm operating overseas, but I can still have currency risk even though I'm just in Australia and I'm only paid in Australian dollars, but my competitors are paid in different currencies, and I might lose out because other currencies become cheaper or more expensive. So I can think that just because I'm getting everything, I'm getting paid in Australian dollars, I've got an advantage, because Australian exporters now, if they're receiving Australian dollars, their products are more expensive than competitors overseas with lower exchange rate. Okay, so you've got this risk, so you have to look a bit wider. Second one is the transaction exposure, and that's simply I get the order, I book an order from someone, I tell them I'll get paid in US dollars, and I fix the exchange rate. The exchange rate is a different risk, is the difference between the spot rate today and what happens when the transaction goes through in a foreign currency. Now, if it's a one day, like an Australian meat exporter, his risk is from an abattoir to a ship here, right? And he gets paid as soon as it goes on a ship. It's driving the meat from Dandenong to the wharf. It's hardly worth worrying about one day. But in big mining contracts and stuff, it can be 12 months for payments. Companies that have dealt with one another for a long time, they will allow payment terms maybe a 12 fixed for 12 months in advance. Every month, 12 months in advance. Commonly, it's between 30 60. Often you see 90 days with currency as well. The translation exposure is a more difficult one. Okay, any students here study accounting? No. Company done accounting? Okay, so you come across the foreign currency standard on foreign currency yet?
I did the account.
Did you do the foreign currency trans? No, they don't do it. All right, that's probably good. Okay, well, it is challenging. Okay, so I buy. I buy these books. Let's assume this book is a factory, okay? And I buy this factory in Italy. There we go. I buy this factory in Italy, and it's valued in euros. But my company's reports are in Australian dollars. Okay? So at the end of the year, when I come to put a value on it, should I adjust it for the change in the euro Aussie dollar and put it in here? Because its value has changed. But the value might be the same in Italy, in euros, but different here in Australian dollars. So what the standard talks about is how you have to translate that. Now it doesn't affect the business because I'm not going to sell this thing, it just helps run my business. But it does distort currency, does distort financial statements.
But don't you fix, especially for companies with subsidiary overseas, don't you fix the rates that you're going to apply in your financial statement throughout the year, for example?
Okay, well,
Yeah.
Well, that look, I can't remember the standard, but I mean that's why I asked who had done it, right? But I mean, then that's an option that you could do.
When I'm done accounting before.
It's a pretty, it's an internet. So you could fix it for the year, right?
Or let's say you vary through the year, and it goes to P&L, the losses.
Yeah.
And at the end of the year, just consolidate everything.
Yep. They might balance out. Yeah.
We do the foreign exchange reserve, isn't it? The company maintains.
Yeah. They made some reserves to balance it out, okay? But you've got to be careful that you know what's happening because directors can use it to distort, like they want to borrow more money, so they use an exchange rate that values this thing higher, gives them more assets, and they go and borrow the money. So you have to understand how the standard works. Well, I haven't seen it for a while. But inventory would be different because inventory is coming in on a regular basis, so you might be able to do an average. Yeah. So for the financial reporting process, they might do an average of inventory, but in your actual accounts, you might be doing the actual exchange rates. Okay? So I mean, you can get distortions here. All right. Now that particular way that they do now, it's even gone further. They call it hedge transaction. That whole standard's been changed because it restricted the use of financial instruments. Okay, because of the way they valued them. Okay, it's like mark-to-market stuff. Okay. The cash flow exposure, I'll talk about that later, but really the cash flow, I'll talk about in depth in a later seminar, but really the cash flow exposure is to do with, I'm a company that imports motor vehicles, right? I enter into a contract to buy these motor vehicles now and pay for them in 2 months. Now what am I going to do in the next month? I'm going to order more motor vehicles and I'm going to pay for them in 2 months. So what's my risk? If I'm an importer of motor vehicles, I have got cash flow exposure. That is, every month I've got risk. Okay? So even though I only hedge out for 2 months, I have the currency risk for longer because I know that in the future I'm going to be continually buying it. Okay? So the issue is, do you hedge just for 60 days or do you hedge for a year? Interesting. Because even though I haven't got the contract, I'm going to be buying at least a minimum amount of motor vehicles. So very few companies can cope with that. Okay. Okay. I'll go back to the euro. Okay. Purchase. Okay. Now the other parity relationship is called purchasing power parity. Okay. I don't spend a lot of time on it because I'm more concerned with with hedging stuff, which is like 2-year time frames, really. Purchasing power parity means that your exchange rate in a floating environment adjusts for inflation. Okay? So you'll find that generally a country that has high inflation rates, its currency will devalue in the future. Right? It doesn't always work. Okay? But in practice it should filter out over a 5-year period. Okay? So how do you do it? In the readings there, I've got the Big Mac thing from 1999, and it shows an index. So what's a product that you buy that's as bad everywhere in the world? It's a Big Mac. It's made of the same. So let's look at price changes in the Big Mac and compare them across country, and one can argue that that's a good indicator of the changes in purchasing power parity. Okay? So if you go to The Economist and put in Big Mac indicator, you'll probably get the 2010-2011 one as well. Okay, so if you're buying The Economist. Okay. Now I thought of another product. Okay. Pardon? An iPod. Yeah, I thought of an iPod. It's got to be the same product. Okay. No tariffs and stuff that distorts it all. So I thought that the iPod would be pretty. Coca-Cola's the other one. Yeah, same thing. So it gets distorted because countries have different tax rates. Okay, it's not quite so relevant here. Okay, so these are good. These are some good websites. There's lots of websites on currency. The Oz4X is the one that I use. It's set up by an Australian trader. He set it up about 8 years ago, and he sold it to one of the banks. So when you look at it, it's actually owned by a bank now. Alanda is probably the biggest international site. It's got an incredible range of resources on it. Forex Factory is interesting because Forex Factory, I use this site because it tells me all the announcements in a week. So what currency announcements they are, when GDP announcements, all those things. Any of you interested? If you just listen here for a moment. If any of you are interested and you want to understand about trading, this is a very good introductory site. It's called Baby Pips. It's very easy language. Yeah, not like mine. Okay. Easy 4X is a site. Okay, so what I'll do is I'll come back to the determinants, but I'll come back to that next week. Gee whiz. So I'll go and I'll show you the technical stuff, all right? And see how we go. So I'll give you the technical and I'll do the fundamental next week, okay? Okay, the Jutna. I think actually that article's Valentine. Duh. Okay, it's a Valentine article, okay? So this one here I've got Jutna. The article's Valentine. It's about the second last article in the readings, okay? He does some good technical stuff. Okay, so the technical. So what I want to explain is just how the technical works, okay? Okay, so what what the technical traders do is they don't worry about announcements or fundamentals. Okay? They work on a computer screen. Okay? But what they should do is there are major announcements that move markets. Okay? The biggest mover of markets happens on a Friday night, about 11 o'clock at night. It's when the US announces what they call non-farm payroll. It's the change in employment, unemployment in the United States. That moves markets. And what you can go to Forex Factory, and you can see Forex Factory, they've got the estimate of what they think it will be, and then at 11 o'clock they announce it, and it changes, and depending on the difference between the estimate and the actual, the markets move. And depending on what the percentage difference is, if it's over 5% difference, the markets move big time. I mean, it's a great learning experience to have a broker open up the market and see what happens at non-farm payroll. I'll alert you to the next non-farm payroll. I've watched it, and sometimes it just goes zip, straight down. Okay?
Every Friday, does it?
No, it's once a month. So if you go to...
BLS announces it.
it's a US one.
Well,
Well, it probably would be in the US, yeah. So it would be. There are other things in the US done by some of the universities have things as well, but I think that one will be done by them, right? So they announce it right on the date, okay? Then they actually, that's an estimate. Then they change it a bit during the week, but the market's just. There are traders that do not trade when on that day when that market because it's so unpredictable. You don't know which way it's going, and it goes big time. Okay. Okay, so you look at charts, highs, low ranges, correlations. Currencies are correlate with one another. Pound US, Euro US generally move similar. Okay, the yen ones move similarly. Okay, short term, long term. Okay, so my experience here in trying to forecast exchange rates has improved a bit, but it's taken a long time actually. And so I've explored a lot of different ways in which you might forecast it. Okay. So one of the ways that they do is these candlesticks, okay? And they got all sorts of names, okay? Now I'll tell you, the most important candlestick is the last one. It's called a pin bar, okay? And a pin bar means that the currency is opened at a particular point, it's gone down, and come back up to nearly the same. Its likelihood is that will go up, okay? Probability of it doing that is very high on a daily chart. Very high probability. If I see a currency that has got an uptrend, and within that uptrend there's a pin bar, I will buy it. Just straight off if it's on a daily chart. Because if it's with a trend, goes down, probability of continuing the trend is probably 80%. Okay? But it doesn't happen that often. So
The buyers are higher than the sellers.
yeah, it's like it's in a trend, it's gone down. And the sellers have pushed it down. The buyer said, "No, we're going to take it back up." And you just look at it. That's why I use this FX Lite, because that gives me the close of day New York, which is 9 o'clock in the morning here, and that's a very good indicator within a trend.
But if
Okay.
enough people do that, it becomes self-fulfilling prophecy.
That's right. So it does. Yep.
It does it because it does it.
Does it because it does. Yep. No, you're absolutely correct. So if everyone thinks like that, what happens? But there are sellers in there, and they've got different reasons. And the big players can manipulate too. Okay? The dojis are just up and down and up, right? It's indecisive. And these others engulfing ones. Okay, so the other thing which is this dynamic support resistance. So dynamic support resistance I'll show on the charts are moving averages. So it's all past data. So how long is the moving average? Is it 144 days? Is it 2 days? All sorts of weird stuff, okay? But markets do come back to dynamic support and resistance. I'll show you some charts. Trend lines, people draw trend lines and they're good at doing it, and currencies trend. I reckon that's why I spend my time learning that rather than stocks, because stocks waver a lot more because they've got a lot of announcements that affect the stock. You know, you don't know what's going to happen. Okay. Time frames, you can trade, this is a 1 hour, 4 hour and the daily. You can do 30 minute, 15 minute, 5 minutes, you can do 1 minute. If you want to. Okay, so So what my research is more recently, and which is really old, this is old stuff actually, but software helps, is using these Fibonacci numbers, okay? So the Fibonacci numbers is like a number 1 plus 2 is 3, okay? 2 plus 3 is 5, 5 plus 3 is 8, okay? 5 plus 8 is 13. So it's a sequence of numbers where you keep adding on the next number, okay? And what this sequence of numbers, it gives you a pattern like what I've shown here. 0, 38.2, 50, 61.8, 100. Now what happens is that the developer of this is, I guess he's an Italian, I guess with a name like that, Fibonacci. It's probably 400 or 500 years old when they developed the technique. The argument is that this pattern of numbers has a lot of things. It's not just financial markets, it's life, okay? Because the stuff I read last night says your ear,
Your arms as well.
okay, your ear has the Fibonacci number. The 0 there's 100 there, and the pattern in your ear will fit into these things, different parts of your ear. Your relationship between your arm and the rest of your body, okay? All those things, if you search on the web you'll find out all these things. The way...
It's a spiral made by the curve of a natural logarithm. Log to the base e of x creates the curve that each progression is in the ratio of 100 to 61.8.
Yeah. So 61.8 is they call the golden number. Okay. So how financial markets work within this? Financial markets move in a trend. Okay. So the idea here is the financial markets moves up to 100, for example, and then financial markets don't go. They just don't go like this. Okay. What happens is they move up. And it's very hard, you have to really study it hard to just, because you always think it's just going to go up, right? It goes up and then it comes down, right? And it'll come down to the 61.8, okay? Now they all measure it, got a tool to, and then they buy. It goes again, right? But obviously there got to be sellers as well, okay? People think the opposite's going to happen. It doesn't always do it, but the probability is really high that it hit those numbers, okay? So what I do is I can... and then they've got the Fibonacci extension. Okay, all right. So I use it. I use the Fibonacci to predict where to sell. Okay, when to sell. Okay, so that's old, and it happens in life. So, and the recent stuff I'm reading on these cycles is these cycles happen all the time. Now there are other indicators which are used by different traders. Pivot points. A pivot point is the close of the price the previous week. It's called the weekly pivot. Okay? And what happens is that if the market opens above that over the week, it'll try to trade and touch that pivot, then it will move. It just happens. Doesn't always happen. You don't know when in a week it's going to happen, but it will, high percentage of some currencies are hitting that weekly number that it closed on the week before. Also as a daily pivot, and Fibonacci is associated with that. So I use these two gap things. I'll show you that I incorporate that with Fibonacci. Okay? And so what I did a whole lot of study on this daily gap, which is a 28 MA and a 24 moving average. So what I've done, what this does, it calculates the moving average for the last 28 days and 24 days. And I'll put them both together on the chart, and I'll show you on the chart. And the market reverts to these. It comes back to them all the time. Okay? It's like it'll move away and it comes back. Now, how do you know when it's going to come back? All right? That's when you use the candlesticks. Okay, so this is one chart. Okay? So you can see that pretty well. Okay, so this is straight off my website called forex.com. Okay? That's the name of the company, and it's MetaTrader 4, which is standard. Okay? So when did I do that one? Okay, so I've had this chart for a little while. Okay, so what I've done with this chart here is, I've made some money here. Very good. Okay, so this number here, that number there, is the close of the previous day. Right? So if I'm using New York time charts, it will be at 9 o'clock in the morning. If I use what's called GMT 0, which is midnight in London, it's about 11 o'clock in Australia. Okay.
Once again, reds are losses.
Reds are losses. Reds are going down. Yeah, they're going
So
down.
this is the one you were saying before. The
Yeah. So this not Fibonacci. So that's a daily one, and what some traders do is that when it breaks the daily, see it breaks the daily, comes back, they buy then, and off it goes. Right. So you're in a trend. You wait till the next day. Again, it's broken through this line. It's come back, touched it again. You wait for a few hours, and off it went again. Crikey, what a beautiful pattern. Okay. So this is the strong trend on a currency, and it's dropping down and comes up. So that's why the traders. Now then what I drew is I drew this trend line here. And you can see here that it's touching this trend line but won't break it and waits for a while. So once you've got 1, 2, 3, then a trend trader will then draw the lines and predict, and here it's gone 1, 2, 3 nearly, then it's 5 times it's touched that number. It's just a trend line, okay? So so it looks like it's targeting that trend line, okay? So what I've done is I've put in a buy here, okay? This Aussie US 85, right? This is when it dropped right down and then it's coming up. See, I should have waited, hang on to that for a long time, shouldn't I? Okay, gone up to $1. Okay, so here it's continuing through, and there's the target there. Okay, okay, so that's one of those. Okay, now this is what I talked about before. Okay, you can neglect some of the lines here, right? But this is this thing that I did a whole lot of work on. This is a chart H1, so it's an hourly chart. So this is the 144, 169 moving average. Okay, and what I did here is it moves away from this moving average, okay, and then sort of comes back, and it didn't, okay, took a while, moved away, right, and then I put in a sell order, okay, because I've got this big candle coming down, right, so it's a red candle going down, so this candle is telling me, very strong candle, so it's telling me that it's going to go down to here, okay, so I'll put in an order to sell here, okay, okay, at 94.72, and it didn't touch it. Oh gee, that's a bit sad. Okay, right. So it's come down. I put it in the wrong place. I should have had it on the red line, okay, because it's come down and touched that, and then it's bounced back again, and I assume it'll probably start going up. So these lines here are what's called dynamic support and resistance line. Right? It takes a lot of effort for the currency to break through, and I know some guys. I've met them, and I've participated in trading sites and stuff. And there's some people that are just really good. You've got to wait for this candle, right? And if you're not awake, you miss it, right? So you can't be awake all the time. Okay. Okay. So that's an interesting one. Okay. Okay, so this one's the Fibonacci one, okay? So what I did here is the market went up and down, and it came down and hit this point here, so that's what I would call, it's not quite a pin bar, but it's a pretty good indicator that that's a reversal. That's a riskier trade, but that's a good indicator that's going to go up, and it has. And then I'll put the Fibonacci, and the Fibonacci, you see this little spot here on the thing? So I just pick that up and I put that number there, I draw it down, and it draws those lines for me. I mean, that's how I don't have to use a calculator, okay? So, but look at it, okay, it's come down, it's come up, what number is that? 61.8. I mean, it's not 62, it's actually right on it. Now, obviously, I saw that and I did it, and I pulled it out to give you a demonstration, like it doesn't always do that, but it has a high probability, okay? So it's hit that number, and then it's gone down, and then I've put another little Fibonacci on there as well, okay, based off different high and lows, okay, one within another one, and it's sitting around the 23.6, okay, that's a 4-hour chart, that one, okay, okay, so this one's a bit jumbled. I mean, this chart's not very good, okay. Yeah, this chart's not very good because at 8:45 on a Monday night it's very hard to work it out, but it's too complex. You're absolutely correct, okay? Alright, so I won't go into it, alright? Okay, but I'll just show you this, okay, before we go. Okay, so what I come across in the last couple of months is, and this is the old stuff, this is called harmonic trading. And interesting, it's pure numbers, absolute pure numbers, Fibonacci numbers. Okay. Now there's a guy called Gartley. He's a real person. He'll be dead now, right? But in 1930 he wrote this book about what he called the Gartley. And the Gartley is a pattern, okay? And you can see it in your lecture slides there. Okay, in 2000, a guy called Conron. I have his book under order. Very hard to get his book. I have it under order, and my daughter's picking it up for me on tomorrow. But he has a book on harmonic trading. You can search. Starts with C. Conroy, I think his name is. Okay. So he's developed the Gartley. This was in 2000. So he developed the Gartley, and he's developed the bat, the butterfly, and the crab. Okay. They're patterns. Okay. And I'll show you what they look like. Okay. So that's a pattern. That's what's called a butterfly. Okay. It's a bit of a lopsided butterfly. Okay. Now what I want to point out to you here is, I'll use this thing here, is that these numbers are all that length there, so it goes down, comes up, and goes down again. So all these numbers are related together for Fibonacci numbers. Right? Then it comes down again, and it goes up to here. Okay? And this is a pattern, and I have a software package that that works this out for me. Okay, so in the past I used to do all the calculations. Oh, it take you forever. So I have a software package, right, and and I can adjust it so it goes up. So what I did, this was done on Friday. Okay, when I got home on Friday night, I saw this pattern. And I had this butterfly, and this is what currency is it? Can you see what it is? US. US yen. My software tells me that, actually, but.
Yeah, but what idea give you about the future of that currency?
Okay, I'll show you. Okay. Okay. The probability, from whether you believe the research or not, is that the probability is that when you see this pattern, it's got a probability of about 70%. That the market's going to go down. Okay? Alright? So what I did on Friday night is when I went to bed at 12 o'clock, I put a sell. Okay? And it went down that far. So when I got up in the morning, I got onto this at 7 in the morning and I sold out because I didn't want to have it open over the weekend. Okay? Because you never know what happens. Okay? So it traded straight off that point there. Okay? But what happens is the market continues up and up, and it gets stretches, so you don't know. Okay, and this little box here, because that's where my stop loss is. Okay, so this is a 2-to-1 risk reward. Okay, so if I win 50% of trades and I have everyone 2-to-1, I earn 25%. Okay, so I add that, and immediately it went down, and I woke up and I was quite happy. Right, so I sold out, and I did 2 of these on Friday night. Okay, so I did 15 last week. I had 8 successful, 7 losses, okay, and it gave, it was quite good, okay. I traded 600, made 300 points, okay. So I'm new to it, but this creates this. So that can be at different points. So what I know now, because I've studied the candlesticks, I actually know that this is a really good position to be, but I need an indicator to tell me that it's going to go down. So I look for a candlestick, okay. And this one here, I actually got in early because I couldn't wait up any longer. All right, not the best thing to do, but it's getting dark, So I'll wait for it to move down. Okay. So, but I did the same with the Euro US, and it went up, but my stop loss was quite tight, and actually traded. So this is another one. What's this one called? Oh.
This one has too much to wait.
Yeah, too much. Okay, so this one. So this trade is a really good trade because what's happened in this one is that you've got a big difference between these two, and what's happened here is this box, which is called the trading zone, which is based on a calculation with the Fibonacci's, meant that the probability that the market will reverse in that zone is very high, but you don't know where it's going to reverse.
Yeah.
But here I'm right at the top of the zone. So I can put a stop loss here up for 20 pips, and I can make 200 going down here. Yes, 200. So again, it drifted down to here, and I closed out on the week, early on the Saturday morning, because I didn't want to. If it had been a Thursday night, I would have left it to go down to here. So I haven't checked it how far it went down today, right? Because the market hasn't been open for that long. Okay. So that's two I did on the weekend. Okay. So here's this one. Here is. Okay. This is the Euro US. Okay. So this is on Friday. This is Euro US. Okay. I'd already traded it twice, and each time it kept going up, right? But for just small amounts. So I'm waiting for the signal. Okay. So I went into this market, right? I did it before at 5:30. You know, my office hours finished at 5, so I went onto the market at 5:30. Right, I can log into my computer from my work computer. So I'm waiting, and I got a down one. So I went into the euro. I think about lunchtime actually, and it was on its way down when I came to class. Okay, so I'm waiting for the indicator. So this is a big. So then I've got this guy here, which I know from my previous study. Is the market, if it starts to move down, it's probably going to target here. There's one guy I've met through Skype in the US. His name's he's a doctor, right? And he trades full time. I think he's a PhD, you know, I don't think he's a medical doctor. But he just trades this. And this guy, for some months, is 100% right. He just knows how it works. But this one here means that there's a high probability it's going to go to here. That's why I've got the stop loss. So this will go up a bit, so I have to adjust it. And that sits on the 38.2. Okay? And notice the 61.8, we've got its confluence here. The 50, it's stuck around there. So anyway, so this is just based on numbers, right? But what I add on to it is the pattern of the candlestick to give the indicator. So I think the probability is really high it's going to go down. So I need another indicator that will confirm that. Okay, so therefore I've got an 80%, 70% probability chance that it would go down at least half the way. Okay, now there's another strategy. There's another pattern called the crab. The crab has got a 90% probability, but I've only ever seen one. Okay, so the ones that happen often are the butterflies, and the probability is not as high. Okay, well whether it's about 70 or 75. It'll move down 12.5% over 10,000, you know, whether it does or, you know, you'd have to do your own research. But I'm just going to add another mathematical model on this to confirm that this is a turning point, because everything I've learned has been to trade with a trend. So I'm turning around here and trading reversals. So it's a little bit different. But what I'm doing here, obviously I'm talking away from what my experience in trading is, but obviously what I'm doing here is this: I'm working for a company, and I'd say there's a high probability that the exchange rate's going to move down. So therefore, if I'm an importer, it might be in my interest to hedge the risk. Or if I'm an exporter, I might wait, especially when it's going to come down. Look, I tell you what, if at 80% probability that you can forecast it's going to move the 2 cents. Okay, you buy a company for £100 million, I mean, gee whiz, it's a lot of money. Okay, you could save. But no matter how good these indicators are, no matter what this happens, the market can still go and will still go the opposite way. Okay, because no one can get it, even though this one guy got it 100% right for a number of months, because he didn't trade very often, he just waited for the perfect setup. Okay, and you have to have software that alerts you to that fact, right? Okay, so then it relates to the logarithmic trading, okay, and I'll talk about this next week. I've got a series of questions, okay. Now I was hoping to do them tonight, okay. So the questions are just really a review of what I've talked about tonight. So you should be able to, during the week, just sit down and write an answer about that, okay? So I'll put those questions up on the DSO, and some of you can put some answers up, okay? So I hope that I have, because of the change in my work allotments, I have 2 people that will be coming on hopefully this week. that'll be on the DSA probably every night, okay? So I'm hoping to create it a lot more interactive, and they'll be putting up a lot of questions, and they will be, they work full time, they're very good finance students in their time as students. They're former students of mine, okay, at work in the CBD. So I've got them, and they'll be coming on hopefully this week. You'll see their names, one Stan and one Shingy, and they'll come on and we'll work out, there'll be generally one probably on every night during the week to answer any of your questions. Any other things will go to me, okay? Okay, so the assignment I didn't do, did I? All right. Okay, I better do that next week. Okay. Right. But I mean, it's a bit harder. If you read through the assignment, there's maybe one question you could do now. But, I mean, I have to go through some stuff for you. Okay. Yeah, there's terms in there that I haven't done yet. I know that. Okay. So, yeah. So I'll do that next week. Okay. All right. Okay. Have a good night then. Okay, let's see.
No, I'm hoping to 6 years. So one way you might want to start playing.
Yeah, you're right, everything, but the calculations just do everything in Excel. Just cost into the document. All right, well that's good. Yeah, so I mean, so the key thing is that what you'll get is you'll get a fair bit of data. The key thing is to use data and analyse the data. You don't give me all the data. So that's where the thinking is. No, I'll put it in. I'll put maybe detailed ones in the appendix, but I mean, if it's a consultant's report, you're going to have to put the basic numbers, but the summary sort of in there, but the others you could put in the appendix. Yeah. Go outside. if you go to, there's a really good website. Actually, I used to do
You'd
it.
have to wait till like week 6 to do that.
Even I was planning only the first question we can just have a look onto it. That's it. And on the next week we can have a
Yeah, I have to do the stuff. I can't do this on